Hello everyone, I hope you guys are doing well and your studies are going in full swing. So let's continue our journey with the additional AI based supplementary questions from our AFM material. And I hope you've enjoyed the first session where we have covered security analysis, security valuation and mergers. Now today we are going to do portfolio, mutual fund. I would say a lot of important questions are there in the mutual fund section. So we'll pick up mutual funds first. Portfolios, mutual funds, risk management, foreign exchange. Largely, most of the topics other than derivatives, interest rates and a few miscellaneous topics we'll try to cover in this session, and the last session will have the remainder. So we'll pick up mutual funds first, then go to portfolio, which has category B and C topics. Mutual funds has a lot of interesting numericals which can be carved out. So if we go to the mutual fund section, the first discussion we should do over here is pertaining to a ratio which is called as the Sortino ratio. Now, Sortino ratio we would have studied, like we have a lot of detailing in our material, in the institute material for the Sharpe ratio, the Trenner ratio or the Jensen's alpha. However, Sortino ratio just finds a formula which is the return of, let's say, the security of the portfolio minus the risk-free rate. So that is the reward in the numerator divided by something called as downside deviation. So first of all, we try to understand how do you calculate the downside deviation and how do you use that in a Sortino ratio. Like every other performance evaluation ratio, this ratio is also higher the better, and it gives you the performance of reward to risk. However, the risk that Sortino looks at is the downside risk. He says that, well, you know what, there's deviation, but what we are more concerned about is the downside deviation. That is what scares us. That is the fear that we have. And hence, Sortino mentions over here that you can have something called as a minimum acceptable return, MAR. If nothing is given in the exam, you can take the minimum acceptable return to be 0%. However, if it is specifically given, you will take that. So Sortino says you take the minimum acceptable return, and any deviation of your actual return which is just below that minimum acceptable return should be considered. So when I'm doing the standard deviation, I consider all deviations, whether it is above or below. However, that is above or below the mean. Here, when I look at the Sortino ratio, I want to take the downside deviation. First, I need to know how to calculate the downside deviation, that is x minus MAR, the whole squared, that you will do provided your x is lower than the minimum acceptable return divided by n and under rooted. And this is what you will use for the purpose of your Sortino ratio. I believe you will know the formula for Sortino ratio, but we want to take a step back to kind of find the downside deviation first. So let us try this. Question number 26. Sortino ratio and downside deviation. The annual returns for a mutual fund over the last 6 years are given below. So you have a set of positive and negative returns. The minimum acceptable return is 8%. Again, if this is not given, you can take 0%. Some people even take the risk-free rate, whatever you're comfortable. But ideally, this should be given. Sortino mentions that this should be available. So minimum acceptable return is 8%. So you will study the deviations below 8% for your downside deviation. Risk-free rate is 5%, and you are required to first find the downside deviation and then calculate the Sortino ratio. So if I have to look at the downside deviation, I will take, let's say, if I call this as x, I will take x minus MAR, the whole square, the minimum acceptable return. Okay, first of all, I'll have to figure out whether your actual return is less than 8%. If your actual return is less than 8%, in this case, no. In this case, yes. In this case, yes. In this case, no, yes, and no. So basically, I would say that at these specific instances, 1, 2, and 3, your return generated is lower than your minimum acceptable return, and hence only these cases will be taken for the purpose of your downside deviation calculation. So over here, you will not consider this. Similarly, you will not consider this. And similarly, you will not consider these 3 observations will not be considered for the purpose of deviation. So the working over here will be 6 minus 8 the whole squared, minus 4 minus 8 the whole squared, 2 minus 8 the whole squared. So this will be what? 2 squared, I believe this is 4. This is minus 12 squared, I believe this is 144. And this is 6, this is 36. So if I total up all of these, the other values I would take as 0 only, in which case this will be 4, 144 and 36. I believe this is 184. Okay, 184. However, this is, if I want to calculate the downside standard deviation, that is equal to under the root summation of x minus MAR, the whole squared, wherever X is lower than MAR, upon N. Now, the challenge over here will also arise when you have to divide by N. Now, someone might say, should I divide by 6 because there are 6 observations, or do I divide only by 3 because I have taken deviation only for 3? Well, Mr. Sortino himself had mentioned that you should take the data set which is entirely there. So your entire data set will be of 6 observations. By the way, 3 of them are lower than your minimum acceptable return, but in all there are 6 observations, and hence over here if it comes, we will take for 6 observations. So over here this is 184 divided by 6. This comes to around 30.66 if I'm not wrong, and 184 divided by 6 and square rooted will come to around 5.54. So this is your downside deviation, one of the most important calculations additionally which can possibly come in. So this is 5.54. So Sortino ratio, downside deviation, is calculated using total number of observations, even counting those observations where there is zero downside test. So this is 5.54, and now once this is done, I would say then Sortino ratio, I hope this is something that you are already aware. So Sortino ratio is actually calculated as your return. Well, I don't know the average return. I'll have to find 14 plus 6 minus 4 plus 10 plus 2 plus 12 divided by, so this is 40 divided by 6, 6.61%. So over here, when I look at the Sortino ratio, I will take your return, which on an average is 6.67%, minus the risk-free rate, which is 5%, divided by the downside deviation, which is 5.54%. Now, this is for one manager. You can even compare this for other managers as well, and then identify the ideal manager. But if I have to look at this, just the Sortino ratio, this is 0.3:1. So this is pertaining to Sortino ratio. What is downside deviation? Deviation from on the lower side from the minimum acceptable return. Why does Sortino ratio use downside instead of standard deviation? Because, well, he looks at a much more pragmatic, practical approach where he says that most people are actually afraid of the deviation that happens on the downside rather than the total deviation. So over here, your Sortino ratio is 0.3, and there is some literature which is regarding Sortino ratio, which considers only downside and ignores the favorable fluctuations which can be there in case of a standard deviation. This is the first point, Sortino ratio and downside deviation. Okay, important thing over here is the calculation of downside deviation in my understanding. Okay, next you have something called as a tracking error. Now, there is a tracking error, like this is very useful in case of what we call as an index mutual fund or a tracking fund or something like an exchange traded fund. What these funds are is they are going to track an index. Now, ideally, people would say, someone as senior as Warren Buffett says that if you don't know the basics of investing, just put your money in an S&P 500 in the US. In India, for example, an equivalent would be a Nifty 50, for example. So over here, you go and you call up your broker, put my money in Nifty 50 or S&P 500. Well, broker says there's nothing called as Nifty 50. It's just an index. It's just a weighted average, which means if you want to actually invest in the Nifty 50, you have to invest in the 50 stocks of the Nifty in the proportionate weight and ensure that you keep on rebalancing when the Nifty gets rebalanced, etc. Now, this may be a little tedious as a task for a regular investor like you and me. And as a result, what happens is there is a fund which is called as an index fund or a passive fund or an exchange traded fund, where the goal over here is you will give us the money and we will deploy that money in the Nifty 50 stocks in the proportion of the Nifty, so that you get a return which is kind of in tandem with the Nifty, or in the S&P 500 in the US, for example. Now, ideally, if you are giving money to these funds, their return should be the same as the Nifty return. But sometimes you will find that there's a difference between the return of the fund and the return of the index. Now, there can be various reasons for the difference. For example, that fund might have certain expenses, like they will have to pay administrative costs, fund manager, etc. So there will be some expenses which will reduce the return. Or there can also be a problem where you might not rebalance exactly when the Nifty constituents change. Like Nifty might remove a particular stock and put in, let's say, a new stock, like they might bring in Eternal or Zomato, and they might remove some other stock. Now, you might not immediately change it. So maybe there's a difference in the return, or there is something called as a sample bias. Like you might say that, okay, Nifty has 50 stocks. Some of them are TCS, Infosys, HCL, all of these are in the IT space. Now, rather than investing in each of them, I will invest, let us say, in one of them in a higher proportion, for example, in which case your returns might be different. Like, for example, very recently, there was a kind of a fight between, not really a fight, that Tata Sons chairman, Mr. Chandrasekharan, stepped down and a lot of Tata stocks fell down. Now, TCS was one of the biggest stocks. This was not replicated in Infosys or maybe HCL. So maybe if you have not invested in the exact same stocks of the Nifty and say taken a sample and invested, maybe your returns may be different. So I want to track the reasons for the difference, for which I will calculate something called as a tracking difference. Now, tracking difference refers to the difference between the return generated by you as compared to the return generated by the index. So if we have generated a 10% return, when the index generated a, let's say, 10.5% return, there's a negative 0.5% that is tracking difference. Now, the thing is, this is for one of the years or one of the months. Now, you might want to see this for a series of observations. And as a result, over here, maybe you have 5 years, and in each of the years, you have your return and you have the index return. The difference between the two will show the tracking difference in each of the years. Now, what is tracking error? Tracking error is like the standard deviation of these differences. That's about it. So when I calculate the tracking difference, that becomes, let us say, your observation, let's say D. So for each of the years, you find the tracking difference, then you find the average tracking difference, and then you find the standard deviation. This is called as a tracking error, quite literally. The institute over here makes a small adjustment which is there in the study material. In the formula, again, truth be told, there is no sum which the institute has asked on this. They might have asked a theory, but not a sum on this. And hence, we don't really know how they will apply it when it comes. So we will see what is to be done from the exam perspective. But before that, let us first try to calculate tracking error. Refer a bit of theory, see how it works, and then take this further. So when I look at tracking error, an equity mutual fund is benchmarked against the Nifty 500 index. So ideally, the return should be the same as Nifty 500. Following are the annual returns earned by the fund and the benchmark over the last 5 years. So the fund's return and the benchmark return. And hence, if I want to find D, which is the difference, this is 14 minus 13, this is 1%. 10 minus 12, this is a negative 2%. 18 and 16, positive 2. 9 and 10, negative 1. 13 and 12, a positive 1. So these are the tracking differences. Compute the differential return for each year. This is also sometimes called as the tracking differences. So we have calculated that as D. Second, average differential return. So over here, you look at the average differential return. It is simple average. 1 minus 2 plus 2 minus 1 plus 1. So this comes to a positive 1. And if you look at the average, this is over 5 observations. So this is on an average 0.2%. This is your average difference. Using the ICI tracking error formula, we will see that compute the tracking error. Sir, what is tracking error? It is the same calculation as standard deviation, that is D minus D bar, that is 0.2 in this case, squared. So 1 minus 0.2 into equal to, this comes to 0.64, negative 2 minus 0.2 into equal to, this comes to 4.84, positive 2 minus 0.2 into equal to 3.24, negative 1 minus 0.2 into equal to maybe 1.44, and 1 minus, let us say, 0.2 into equal to 0.64. So if I take the total of all of these, what do I get? Well, I will get approximately, just a second, 3.24, 1.44 and 0.64, maybe 10.8. I will get a total of 10.8. Now, ideally, when I look at the standard deviation or the tracking error, the formula should be under the root summation D minus D bar, the whole squared, which we have done, divided by N. Ideally, it should be N. Now, over here, they've taken N minus 1. They've copy pasted this formula from somewhere. And generally, if I give you a background in statistics, there's a concept of a sample and there's a concept of the entire population. And this is across statistical measures. Usually, when you just take the sample, maybe out of a large population, you just take a sample and you take the workings there, then you usually divide it by N minus 1. But in case of the entire population data, you divide by N. Now, the problem over here is, ideally, over here, one might say that this is a sample of 5. Well, that sample can also be across your portfolio and mutual funds chapter. None of the places have they taken N minus 1. Everywhere they have taken N. However, if I review, this is exactly from your institute material. We have taken this extract. If you see this, just a second, where is the mutual fund chapter? Okay, this is mutual fund. If I look at mutual fund, in this case, there is this tracking error. There's the entire theory can be defined as a divergence or deviation of a fund's return from the benchmark's return. So this is the difference based for tracking error. There's a bit of theory, you can refer that. And the tracking error formula is defined as d minus d bar the whole squared upon n minus 1. This is what ICI has printed, and I've even given you the page reference. You can refer that. Now, ideally, everywhere you should take n only, but here because you have taken n minus 1, I will end up taking n minus 1 if a similar question comes in the exam, and mention that alternatively I can solve by dividing by n as well, because in the institute study material this formula is there where they have taken n minus 1. In my limited understanding, consistency demands that across your material, if you have taken divided by n, even over here they should take divided by n, but if it is n minus 1 over here, to maintain peace over here with the institute, we will ensure that we will take n minus 1. As we say, Sortino ratio uses downside deviation instead of total standard deviation in the denominator. So if I review the working over here, we will have, let us say, under the root, maybe 10.8 divided by, in this case there are 5 observations. I will take 5 minus 1, that is equal to 4. Sir, I'm not using the calculator for that, don't worry. So this is divided by 4, 2.7 square rooted around 1.64. So this gives you maybe the tracking error calculation. So this is 0.2%. This is 1.64 ultimately, which is coming as tracking error. So it's an important numerical which can come up, right? And so this is 1, 2, and 3. There's no question specifically asked on this apart from just general theory. Briefly comment on whether the fund has tracked the benchmark efficiently. I would say, well, there is a difference which is coming, and hence I would not say it is exact matching. So 1.64 indicates that the fund's return deviates by around 1.64% from its benchmark. A lower tracking error indicates better benchmark replication. Again, we have written a note on that n-1. Tracking error is usually is in this case using sample standard deviation. Well, that way that standard deviation can be for a sample even for regular portfolio questions. Therefore, n-1 is taken for tracking error calculations, even though several other chapters in AFM commonly use n while computing standard deviation. So ideally we should take n, but if a tracking error question comes, to keep peace with the institute, we will take n-1 and write an alternative note in the exam that alternatively we can even take n. Okay, so these are two important concepts. Then there is this plan in case of a mutual fund, which we call as a direct plan. There are three concepts that we will cover in this question. First, there is direct plan versus regular plan. Then there's a concept of trail commission, and there is expense ratio. Now, usually what happens in case of mutual funds is when you invest in a fund, the fund will invest those securities. However, the fund will generate a return, but the fund will have its own expenses. Like they have to pay the fund manager, they have to pay administrative costs, they have to pay compliance charges, research cost, all of these. So these costs will pile up, and the total of these expenses divided by, let us say, the fund's average assets gives you what you call as an expense ratio. Now, ideally, the lower the expense ratio, the better it is. However, what happens is the funds want a lot of people to subscribe to their funds because there are a lot of funds in the market, and hence there are distributors. To these distributors, they pay a commission, which is called as a trail commission. Now, this commission is paid anywhere between 0.5 to 0.7%, and this is paid, let us say, over the period of time to these distributors. So if you invest maybe using, let's say, a Motilal Oswal app or a Zerodha app, using, let's say, if you invest in a regular fund, maybe your investment has come through a distributor, maybe through a Zerodha, maybe through a broker, in which case the fund will then pay commission, let's say monthly, quarterly, annually, whatever it is, to these intermediaries. Now, I don't want them to pay commission. I don't want their help. So in that case, you can go directly to the mutual fund and there will be a direct plan. And in that direct plan, it is the same fund, same asset, same portfolio, same manager. However, there is no trail commission to be paid if you directly invest. Maybe you can go through directly to the fund's website, or maybe not through a broker or a distributor. And how will we know in practice if you have invested in these funds? If it is written regular, let's say HDFC regular so and so plan versus HDFC direct so and so plan. If it is direct, that means that fund will have a lower expense ratio because it does not have to pay trail commission. So over here, sometimes you might see a question where you might have to calculate the total expense ratio. In case of a regular plan, your expenses will include the regular portfolio expenses. Along with that, it will also include trail commission. In case of a direct plan, trail commission will not be there, and hence the return generated by a direct plan will invariably be slightly higher as compared to, let us say, a regular plan, because it is the same asset base. Like for example, a portfolio a mutual fund might have 100 crore worth of assets, 80 crores it might have raised using distributors, and 20 crores maybe people have directly invested in the fund. In which case, for that 20 crores, that same manager is going to manage the entire 100 crores. For that 20 crores, it will have a slightly different return slash NAV published, because it's a direct plan. As compared to the 80 crores, it will have a different return slash NAV, because in that there has to be trail commission. The problem in practice is most of us don't even know that there's a trail commission being paid, because most plans we invest through a intermediary or a platform. But practical application we will see. For the time being, we will try to see these concepts of a direct plan where there is no trail commission or no distributor involved versus regular plan. Trail commission is something where it is a commission paid to a distributor who is helping the fund in raising, let's say capital, and expense ratio is your total expenses divided by the assets which the mutual fund has. So question 28, ABC mutual fund offers regular and direct plans under the same equity scheme. Both these plans are managed by the same fund manager and invest in an identical portfolio. Maybe 20 crore is the total money in the direct, as well as 80 crores coming from regular. So that manager manages the entire 100 crores together. During the year, the scheme earned a gross portfolio return of 16%, and the following expenses were incurred. Well, there were other operating expenses of 0.55%, and there is a trail commission. What does a trail commission mean? It means commission which is paid to the distributors for the funds that they've managed to kind of garner, and this trail commission is around 0.65%. An investor invested 10 lakh for 1 year. Compute the expense ratio of the regular plan. Well, on the regular plan there will be 0.55% plus 0.65%, so maybe 1.2% will be the total expense ratio for the regular plan, and for a direct plan this will only be 0.55%. There will be no further trail commission to be paid. Calculate the net annual return earned by the investor under both the plans. If I have to do it in a percentage base only, I would say 16% minus 1.2. Well, this will come to approximately 14.8, whereas 16 minus 0.55 will come to around 15.45. Now you might say that there's a slight difference, but that is for a single year. If your investment is going to stretch over, let's say 5, 10, 15 years, that's a fairly big difference. Calculate the difference in wealth created for the investor after 1 year under two plans. Well, the wealth over here, if I go to see under the regular plan, will be, you had 10 lakhs plus maybe you would have earned 14.8%. So this is 1,48,000, and hence the wealth would be 11,48,000. Whereas in a direct plan, this you started with 10 lakhs plus 15.45. So this is 1.545. So this will be around, I would say, 11,54,500. So there is a difference, I believe, of around 6,500, which is almost a little more than your monthly articleship stipend. So that's a fairly big difference, right? So over here, sorry, I'm sure it's just a matter of time. After this, you're going to add 2 zeros to your monthly salary in no time. Okay, so over here, this will be the difference in wealth. Briefly explained why direct plan generates a higher return despite they investing in the same portfolio. Well, because it does not have to pay what is called as a trail commission. So this is 1.2% under the direct plan. Under the regular plan, 0.55%, 14.8, 15.45. This is your total wealth, and the additional wealth under direct plan is 6,500. The same portfolio is managed. It is just that the regular plan bears trail or distribution commission, which is increasing the expense ratio, where the direct plan does not incur this cost. And this is the primary source for the difference. Okay. Next, you have another concept. Now, before you go over there, there's something called as side pocketing. Side pocketing, in case of a mutual context, is very similar to, let us say, something which is like a demerger. So when I look at, let us say, a demerger, or in case of a company, what happens is, when I'm looking at, let us say, a company, let's say one of these divisions is not doing as well. What I do is I demerge this division into a separate company, and I continue to run my existing company, and the new company that is formed, maybe I will give the shares to the existing investors. So if someone wants to take exposure to both, they can buy shares of both the companies. My existing shareholders, let's say when there was Bajaj had Bajaj Auto, and it had an NBFC division, Bajaj Finance. It demerged. Bajaj Auto continued as it is, and a new Bajaj Finance was formed, and shares were given to the existing shareholders. So Bajaj Auto shareholders continue to have Bajaj Auto shares, plus they will not also get Bajaj Finance shares. However, if a new investor only wants exposure to the auto business, then he can directly go and buy just the shares of the new demerged company. Now, in case of the mutual fund context, the same applies. Like if I have a portfolio of investments, some of them are, let's say some of my investments or bonds, etc., are in distress. Now, I don't want that to kind of pollute my entire overall portfolio. So what I do is I create something called as a side pocket. It is just a fancy word. It is a demerger, quite literally. I create a side pocket, and in that side pocket, I will, let us say, have these distressed assets. So earlier, if I had a net asset of, let us say, 100, out of which, let us say, 10 rupees, 15 rupees, whatever it is, are under distress, I'll remove that 10. My existing company or existing fund will continue to have the net assets of 90. This 10 will be parked into a separate side pocket, and the company will then, mostly the fund manager is a fund manager who is trying to track bonds. He's not really a collection expert, so he will probably pass it on to someone who is an expert in managing distressed debt. So the existing holders will continue to hold the existing units, plus they will get new units in the side pocket. We will see that numerically, you will understand it better. The new investor who wants only exposure to a clean portfolio of investment will directly find the new units, and they will not be exposed to that distressed asset. So over here, this is in a way the concept of side pocketing. We'll read the theory, but more importantly, we will try to apply, let us say, the numerical aspect over here. Like trail commission is the amount that a mutual fund pays to his advisor each year. The purpose of charging this commission from the investor is to provide an incentive to the advisor to review. Distributors usually charge a trail commission of around 0.3 to 0.75% of the value of the investment, for example. This is trail commission. Then you had this concept of direct plans are purchased directly from the AMC without distributors. Since there are no distributors or trail commissions, they have a lower expense ratio and generally higher NAVs, as we saw. And let us say we have this side pocketing concept. Again, I've given a referencing this is institute's language only so that you are aware. Side pocketing, we have this separately in theory, but this is now a practical impact we are seeing. Side pocketing leads to a separation of risky or doubtful assets, let's say distressed assets, from other investments and cash holdings. The purpose is to make sure that the money invested in a mutual fund, which is linked to stressed assets, gets locked in. Like I'm not taking, I'm putting that into a separate side pocket, like a demerging it, until the fund recovers the money from the company or could avoid distress selling of illiquid securities. So the modus operandi, that is the way they operate, is simple. So this is like a demerger situation only. And for this, if you want, we have, let us say, a question, I think question number 29, which we are going to review. So let us look at question number 29, side pocketing. ABC's credit risk mutual fund has a following portfolio before any credit event, that is before any default. There's liquid securities of 900 and bonds issued by XYZ of 100, and hence the total portfolio is 1000. The scheme has 100 crore units outstanding, which means ideally before any problem, my NAV before any side pocket, if I were to see, would be 1000 divided by 100, which comes to, let us say, 10. On 1st of April, XYZ's bond is downgraded sharply and AMC decides to side pocket that security. So this 100 will now be put into a separate, let us say, side pocket or a separate, separately managed fund, like a demerger. Immediately after the downgrade, the estimated realizable value of the bond falls to 40 crores. The AMC transfers this impaired bond into a separate side pocket scheme. 1 year later, the liquid portfolio grows by 10%. So this will become, let's say, 990, and the side pocketed bond ultimately recovers 55 crores. Okay. Compute the NAV. So for 1 year, maybe there's no redemption pressure, etc. I put that into a separate side pocket. A new investor who wants to invest can invest in my main flagship scheme rather than, let us say, the side pocket. Compute the NAV of the main scheme and the side pocket immediately after side pocketing, and compute the value per unit after 1 year. Sir, let us say if I look at the NAV of the main scheme immediately after the side pocket, I would say that, well, this would be, let us say, 900. There's no change over here. This is at year 0 only, divided by 100 units. So this will be 90. And for the side pocket, this is for the main scheme. If I look at the side pocket, this will be probably around Well, 100. However, when I transfer, this value is 40. So 40 divided by 100, this comes to, I think, is it? Oh, this is 9, not 90. My bad. Bad calculation. Sir, you should use calculator. Yes. Sorry. So this is 0.4. So my total wealth right now is around 9 plus 0.4. This is 9.4. I'll have units. Compute the value after 1 year. Sir, after 1 year, what will happen is plus 1 year. I will say on my main scheme, my bonds will become, I think, 90 plus 10%. So this 900 plus 10%, this is 990 divided by 100. So this is 9.9. And on my side pocket, I could eventually recover 55 upon 100. So this will become 0.55. So basically my wealth will become 9.9 plus 0.55, that is around 10.45. Okay, initially my wealth was around 9.4 and this went, let's say, up to 10.45. An investor is holding 10,000 units on the date of side pocketing, continues to hold both the units. Determine the total value of his investment after 1 year. Well, you will multiply this by 10,000. You will multiply both of these by 10,000. So basically his value will be 9.98. So this is probably 99,000 and I think 5,500, and that's about it. So initially it was 10. On side pocketing, this will become 9 and 0.4. So total wealth is 9.4. After 1 year, this is 9.9 and on the side pocket it is 0.55. So total is 10.45. And the investor's wealth under the main scheme is 99,000. Under the side pocket is 5,500. And hence 1,04,500 will be your total wealth. It is exactly like a demerger case. However, when you see words like side pocket, you get scared. You said, oh, what will I do? There's just a fancy word for a demerger calculation. Briefly explain why side pocketing is considered fair for long-term investors. Maybe for the existing investors, I will separate both of them and the fund can focus on the better collection of distressed asset. For a new investor, I don't want to give them an exposure to these distressed assets. So I will have, let's say, a scheme which will just focus on the performance. So side pocketing protects fairness among investors. So the impaired security is separated from the healthy portfolio. Existing investors continue to hold both the main scheme and the side pocket units. The new investors, after segregation, will only have the healthy portfolio and do not receive any benefit or risk of the stressed asset. Any future recovery from the impaired security is attributed to investors who held the units at the time the side pocket was created. So this is the concept pertaining to side pocket. Okay. Question number 30 we will do, but before that, there are a few other things in mutual fund maybe that you should also know. Like we have always heard about a close-ended and an open-ended scheme. However, there's also an interval fund where what happens is in an open-ended, you can always enter and exit whenever you want. In a close-ended, you cannot. You can only enter when, let's say, the new fund offer has happened initially and redemption happens when the fund kind of closes down. Before that, you can buy and sell the unit on the exchange. So in order to balance between the two, recently there have been a lot of funds which are interval funds. So SIP culture is very strong in India these days. So what systematic investment plan, that is SIP. So what these funds, the manager wants to do is he wants to have this money that he manages without any disturbance of day-to-day new money, redemption, etc. So he wants like a close-ended fund. However, that is blocking down all the new money that could have come in. And hence, what a lot of these funds have been doing these days is they keep their fund open for an interval, let's say 1 week, starting from the end of the month, let's say around 28th of the month and ending at around 3rd. Like most of the people have their auto debits on their salaries on the first week only. So maybe you are open to receiving money at the beginning, and maybe if someone has less money at the end of the month, they have kind of used their entire let's just say salary. Like you have this Gen Z language, what YOLO, you live only once, right? So you have spent everything and last you don't have money, so you're open to redemption in the last few days and open for entry in the first few days of the month, and that's it. That is when the fund gets locked. So this is like a hybrid, if it comes in an MCQ, between, let us say, what do you say, open-ended, where it is open for a few days, and then close-ended, where it is closed for the remaining part, for example, of a month. So that is like an interval fund. There's also exchange-traded funds which are very popular these days. If it comes ETFs, like ETF is like a security only. It's like literally a share which can be bought and sold. Like one of the most popular ETFs is on the Nifty 50 called as Nifty Bees, for example, where let us say you want liquidity, like you want to buy and sell the Nifty whenever you want. So one option is you take a index mutual fund which tracks the Nifty. Another thing is you can take an exchange traded fund, which is like a stock which you can buy and sell on the stock exchange in the normal way. So this is like an exchange traded fund. And there has been one question that came in the recent exams where we tried to look at, let us say, returns. And in that they asked you geometric mean. So if you want to see that question, we have done that exact question in the May 26 main exam video. I think question 4B or 5B, I'm not wrong, was that question. But based on that, we're trying to expand our view over here to do question number 30, where we try to study what we call as the measures of central tendency. What do you mean by measures of central tendency? Before you go to this question, we'll study what is a mean, that is arithmetic, geometric, and even a new concept, a harmonic. It is not there in the study material, but who knows, they can ask you anything. And then there is a median, then there is a mode. So this is more of a statistics question where you look at measures of central tendency, mean, median, mode, within mean, arithmetic, geometric, and harmonic, and when each of them is useful. So what I've tried to do over here is I've tried to formulate an example where I'll first explain you each of these terms and then come to this question where we can discuss each of these concepts as well. So over here, if you look at an example, something like this, let us say there is a data set of around 4 observations. In year 1, you get year 1, 2, and 3, and 4. You get returns of 10, 20, 30, and again 10. So these are your 4 observations. Now, what are the measures of central tendency? Well, there can be mean. Within that, the most common measure of mean is the arithmetic mean. What does arithmetic mean? Do a simple average, that is 10 plus 20 plus 30 plus 10 divided by 4. That comes to 17.5%. This is called as a default. If they just tell you to calculate average, the mean will be the arithmetic mean. Now, what came recently was the geometric mean, which came in the May 26 exam as well, which is nothing but the compounded average annual growth rate, CAGR. So when you calculate the geometric mean, what you will do over here is, well, 1 plus R, that is the geometric mean. R, capital R over here is the geometric mean raised to 4. Let's say there are 4 observations. You'll say 1 plus, let's say return in percentage. So 1 plus R1 into 1 plus R2 into 1 plus R3 into 1 plus R4. So basically 1 rupee that you start with becomes how much after 4 years? So, well, which means on an average you're earning how much? So we'll do sums on this. I'm just trying to run you through so it is easier. So 1 plus R4 over here will be 1 plus 0.1 into 1 plus 0.2 into 1 plus 0.3 into 1 plus 0.1. So maybe and geometric mean is good, arithmetic mean is good for, let us say, calculating the averages. Like arithmetic mean in a way looks at the simple base, geometric mean looks at the compounded average return. So over here you are multiplying, so you'll get 1.8876. This equals 1 plus R raised to 4. And you will take the 4th root. Well, this you can take directly on your calculator. In case, let us say it is a 3rd root, 5th root, 6th root, maybe you'll have to use certain calculator shortcuts like root of 12 minus 1 if you have done something like that. And get the answer here. This is 1.1721. So this is 17.21%. This is called as geometric mean. This is very good if you want to calculate the compounded average annual growth rate. Geometric mean, this is your formula. Next, you have something called as harmonic mean. It is something that you might have studied if you have studied long time back in your foundation. But what is a harmonic mean? This is usually like the inverse. Like usually when we take the arithmetic mean, we take R1 plus R2 plus R3 plus R4 divided by n. Here, and you take the opposite. So n comes in the numerator, and in the denominator, instead of taking R1, R2, R3, you take 1 upon R1, 1 upon R2, 1 by R3, 1 by R4. So this is the opposite. Like usually n comes in the denominator, here n comes in the numerator. Usually R1, R2, R3 will come in the numerator. Here you take 1 by R1, R2, R3 in the denominator. Usually this is not a good measure to find the average of percentage returns. Like you will never see in practice people calculating harmonic mean for a financial percentage return, but it is a good measure to calculate the average return for, let us say, something like ratios, like a P ratio. A lot of people take harmonic mean. Again, you should not take that. If nothing is in, you'll take the simple average only, but people take P ratio or the speed, which is kilometers per hour. All of these are a good basis to find for harmonic mean. So over here, if you take 1 divided by 0.1, 1 upon 0.2, 1 upon 0.3, 1 upon 0.1, and you get your harmonic mean to be around 14.12% if it comes, rarest of the rare case. But we are prepared. There's no further measure of central tendency in mean. There are these 3 measures. If something comes, we are now prepared. When we look at median, what does median mean? Well, median means the center observation. Now, if it is 5 observations, it is easy. The third observation is a central observation. But if it is 4 observations, that is an even number, then you'll have to find, let's say, like from the beginning, if you take 1 and 2, from the behind, you take 4 and 3. So it is, let's say, it can also be 2, it can also be 3. We'll take the average between the second and the third observation. Like over here, in case of a median, what you will do is you'll sort the data, like first 10, then 20, then 30. You'll sort the data, and so the median comes somewhere between 2 and 3. So this is between, let us say, 10 and 20, and hence your median would be around 15%. Again, even this problem arises because it's an even number set data. If it is an odd number set data, you don't, the exact third observations in a 5 observation series will be your median. Now, median is very popular when data has a lot of outliers. Like for example, if your fourth observation over here instead of 10% was, let's say, 100%, like it's an outlier, then that will pull up the mean significantly, even whether you took arithmetic, geometric or harmonic. Like you take 10 plus 20 plus 30 plus 100. This is 160 divided by I think 4, and you get this 40% average return. Now, most of the years you have not even come close to 40, but that one observation is pulling up everything significantly, and hence in such cases median is generally popular. Again, from a cost, at the cost of a repetition, from a student standpoint, if average is asked, you will always take arithmetic mean. But like May 26, they asked you specifically geometric mean. If they ask you median, if they ask you let us say harmonic mean, something that you should be aware. And mode is something which is data with the maximum frequency. Like over here, 10% comes 2 times, so that is the most frequently visited observation. So 10% becomes the mode. So these are the measures of central tendency that we take, based on which we have a problem, question number 30. So this is more of a statistic problem, and this is not unique to mutual fund. This can come in any of your syllabus. But if you have done this once, then you have this mental piece that by if geometric mean is asked, something else may be asked tomorrow. Now we have done all measures of central tendency. So over here, the percentage returns earned by an equity share over the last 6 years are given below. So you have this data. You're required to find the arithmetic mean. So this is 8 plus 12 plus 16 plus 12 plus 20 plus 22. So this is 90 divided by 6 comes to around 15%. This is your arithmetic mean. Okay. When I look at geometric mean, on the other hand, this will be 1.08 into 1.12 into 1.16 into 1.12 into 1.20 into 1.22. This will equal 1 plus r raised to 6 compounded average growth rate. Let's say that is r, and this is, let's say, 1.08 into 1.12 into 1.16 into 1.12 into 1.2 into 1.22. So ये आपका, this will become 2.3007. I think this is printed a bit wrongly, plus 1 plus r raised to 6. So this is 2.3006, approximately 2.3006 or 7. And if I take the working, 2.3007 raised to 1 by 6. Now, how do I do that? Well, there are multiple tricks maybe to do it on your calculator. If you have done one of them, you do it by that method only. But what we typically do is, we will take this number on our calculator, we'll square root it 12 times. So you press the square root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Whatever number comes, I think ending 4193, you subtract minus 1. Okay, after this, why were we doing this? Well, because we had to divide this, do the 1 by 6 adjustment. Okay, so you divide it by 6, or you multiply by 1 by 6, whatever, divide by 6. Then you, this is like finding, in a way, loosely speaking, the log values. Now you do the anti-log. So you take the opposite. You do plus 1 and then into equal to 12 times. So this is plus 1, and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So maybe around 14.14, I mean 14.9 approximately. If I go, you'll have to verify this once, but if I go to see, this is approximately 14.9%. You can say this is your geometric mean. Now, when you look at harmonic mean over here, this is the opposite. So 1, this is 6 divided by 1 plus point, you can take point, or you can take directly 1 divided by 1 by 8 plus 1 by 12 plus 1 by 16 plus 1 by again 12 plus 1 by 20 plus 1 by 22. And then you can find this comes to approximately 13.35%. This comes to be the harmonic mean. Now over here, harmonic mean is asked as it is given, though it is not very popular to find percentage returns. Mostly it is used for the purpose of ratios. In a financial context, PE ratio, EV by EBITDA ratio can be done if specifically asked. Compute the median and the mode. Median, I will arrange data in the ascending order. There's 8, 12, then again 12, then 16, then 20, and then 22, which means maybe the median is somewhere between the two, 12 and 16. So this will come to probably 14 once the data is arranged, and that is 14. Mode is what is the most frequently visited, which is 12, and hence your mode comes to 12. So these are measures of central tendency, and the appropriate use of each measure. Arithmetic mean is to find the average return. Simple, so this is using simple, whereas geometric mean is used to find a compounded return. Harmonic mean is to take average of ratios, usually PE ratio, speed, cost per unit, etc. Where smaller observations deserve a greater weight as well. In arithmetic mean, the larger observation usually pulls up the data a lot, and in median, when data has extreme values like outliers, the middle observation represents a data set better, and this is the most frequently occurring observation. So in case something comes on these lines, we have now taken a comprehensive view to cover everything which is possible over here. So this is, let us say, considering mutual funds. Next we go to portfolio. Now honestly, in portfolio you have a few theory concepts based on which we have based it, but it is not as much as mutual fund where you can have, let us say, numerical. So in portfolio we will discuss a bit more on the efficient frontier in terms of the diagram and the theory which is propagated by Harry Markowitz, which is there, but we'll discuss it a little more length in case something on those lines comes. And let's say the capital market line theory also, which is there, but we will discuss it a little bit more. So these first couple of questions on efficient frontier and capital market line theory can deserve a bit more weightage. So we'll take this further. First of all, before we go to efficient frontier, we might have discussed something which on a simplified terms is similar, which is something called as the theory of dominance. Now, what does a theory of dominance say? It just says that if there are two securities or two portfolios where one of them, let us say, has a higher return and risk. Let us say if I look at portfolio, let's say if I look at return and risk, for example, there's a portfolio A, there's a portfolio B. Portfolio A has a 10% return, portfolio B has a 12% return. Both of them have a 5% risk, in which case B dominates A. It gives a higher return at the same level of risk. So A is dominating. A is a more efficient portfolio at the 5% return. At the 5% risk, the maximum return that can be generated is, for example, 12%. Or let's say another possibility can be, if let's say there is A and B, where A generates a return of 10, B also generates a return of 10, but the risk over here is 4, the risk over here is 3. In which case, again, at the same level of risk, at the same level of return, B generates a lower risk, and hence B is the efficient portfolio. So at the 10% return, the lowest risk that can be achieved is, let's say, 3, in which case it is an efficient portfolio. Or for example, when we look at another situation of, let's say, A and B, where you have A which is at 10, B is at 12, A which is at, let's say, 5, and B which is at, let's say, 4. I would say that B generates a higher return at a lower risk, nothing like it. So B is the efficient portfolio, it dominates A. When does it not dominate? Well, it does not dominate when between A and B, A has a 10% return at a 5% risk, B has a 12% return at, let's say, a 6% risk, for example, or a 6.5% risk, for example. Now, I cannot say that B dominates A. Yes, it has a higher return, but it also has a higher risk. So what Harry Markowitz did is, he tried to plot all the portfolios at all levels of risk and return. Before I go into, let's say, this numerical, what Harry Markowitz did over here is, he tried to find a entire curve where he tries to plot the return on one of the axis, the risk on the other axis, and he finds portfolios, and at each level of risk, let's say there are various levels of risk, at each levels of risk there are multiple combinations. At each level of returns also there are multiple combinations. However, at each level of risk there would be a level, like over here there is A, but maybe there is a better portfolio lying over here. So there may be multiple portfolios, but this is the best. So at, let's say, I don't know, whatever this percentage is at, let's say this is 10%, the best return that can be generated, maybe let us say 15%. Now, if I want to take a higher risk, maybe I'm okay taking 12%. Well, I will get multiple portfolios, but the best portfolio over here may be C, and C over here may be generating, I don't know, maybe a 18% return. In a similar way, I go further. I keep on going. Now, F, E are basically inefficient portfolios because they are giving at a particular level of risk, they are giving a lower return where there is a higher return possible at the top. And maybe D over here, one might say, is giving the highest level of return, but you know what? It also has a much higher risk. So what, see, you cannot earn an infinite return, right? So over here, he has tried to build up a frontier. So this is that frontier over here where you are saying that these are where the efficient portfolios are lying below this line, or even are the inefficient portfolios. So when I look at the portfolios, let's say something like B, something like C, something like D, which are lying on the efficient frontier, these are the portfolios which at a given level of risk give you the highest return. There may be other portfolios as well, which at the given level of risk may give you a relatively lower return, or at a given level of return might carry a higher risk. However, these are the absolute efficient portfolios, and this frontier is called as the efficient frontier. Now, this is, let's say, if it comes from a theory perspective, what is the efficient frontier? It is basically a combination of portfolios which give you the highest possible return at a given level of risk. But if you want to increase your return, well, you have to also increase your risk. If you want to decrease your risk, well, you have to also be ready to decrease your return. So this is a frontier or a set of your optimal portfolios, which means which is a portfolio that you should be selecting. Well, it depends on your risk aversion. Like certain investors may be risk averse, so they might be saying that I want maximum 10% risk, in which case you will, in a way, in economic terms, you don't have to do that for the exam, you will have to draw these indifference curves. If you are aware, there are these indifference curve 1, 2, 3, 4. These are indifference curves. These show the utility for a particular investor. So we will say that, well, there is no one optimal portfolio for everyone out there in the market. There may be some people who are very risk seeking, like these venture capital, private equity guys. They are okay taking a much higher risk, but they are betting on a possible much higher return. But there are some people who are relatively much more safer, much more conservative, in which case it is not that one is right, the other is wrong. We have to find the optimal portfolio based on the risk preferences for our investors. So let's say there are these different indifference curves, and they say that the optimal point on a theory level will be the tangency portfolio. So this is, let's say, over here at this level, you will generate the most efficient portfolio, and this also kind of overlaps with the utility that the investor generates. It's a lot more technical over here, but if you want to study, well, you can go into a lot of detail. You can just look up the efficient frontier for given by Harry Markowitz and the indifference curve, and you will find a lot of literature. But I would say from an exam perspective, what you need to know is an efficient frontier will comprise of efficient portfolios. These are portfolios which give you the best possible return at a given level of risk, or the lowest possible risk at a given level of return. So these are the dominating portfolios at a particular level of risk and return. Now, there is a set of these efficient portfolios. Which of us is the best for us? Well, the portfolio where your indifference curve is tangent to the efficient frontier is the portfolio considering your utility, your risk aversion, your risk seeking nature, and let's say the available portfolio. So you just need to remember that your optimal investment under the Markowitz model would be the investment which is, let's say, a tangency portfolio, which is a portfolio where your indifference curve is tangent to the efficient frontier. So over here, this is, let us say, your efficient portfolio, and they're just trying to figure out over here a lot of theory which is pertaining. I'll share that as well, but I would say that broadly, if you understand this essence, you are in a way in a good position to broadly manage, let us say, the efficient frontier and let's say the tangency portfolio. So you have found the optimal portfolio over here. So they're just mentioning that, well, at point B, the level of risk and return is optimum. The return are highest at D, but simultaneously it carries a higher risk than any other investment. However, you may not be ready to bear that kind of risk. So for you, D may not be the optimal portfolio. So over here, this is like the Tangency portfolio. Now we will try a question on that to apply this and then go into the capital market line concept as well. Like efficient frontier, it does not the numerical is not as intense as the theory probably sounds. So 4 portfolios are available to an investor. You have expected return and the risk in terms of standard deviation. Which portfolio dominates portfolio A? Give the reason. Well, if I look at portfolio A, it has a 10% return and 8% risk. There's a portfolio B which has a 8% return, which is 8% risk, which is the same as A. However, it offers a higher return, which means clearly we can say that B will dominate A in all situations. Maybe between A and B, B will lie on the efficient frontier because at the same level of risk, it is offering a higher return. So maybe B will dominate A. Which portfolios are likely to lie on the efficient frontier? Well, the dominating portfolios will lie. A will definitely not lie on the efficient frontier because at 8%, maybe B will generate a higher return. Now, other than that, between B and C as well, they have the same return. So over here, between B and C, we can say that there is the same return. However, again, B carries a lower risk for the same return. So even between B and C, B will dominate. Now D over here has a higher return. It also has a higher risk, and hence maybe the portfolios B, portfolios D will lie on the efficient frontier. Okay, so this is these points. If an investor currently holds portfolio C, how can the investor improve the position even without reducing the expected return? Well, you can switch to B. So I'm currently earning 12%. Well, I can keep on earning 12% and maybe switch to B and settle for an 8% risk. So C over here is an inefficient portfolio, whereas B seems to be a much more efficient portfolio. So as the first case, we're saying B dominates A. Second, we're saying B and D would be efficient portfolios. Well, they are giving you, maybe B is giving you a return which is best considering the risk as compared to, let us say, A and C. And we will switch from C to B because that will give us the same return but at a lower level of risk. Okay, so this is regarding question number 21. Sometimes the institute calls this as a theory of dominance. Sometimes it calls this as efficient frontier concept. So it is just that if the question comes saying efficient frontier, you don't have to panic. It is the same principle and same concept that you apply for the theory of dominance or common sense, basically, whichever portfolio based on the mean and variance, mean and standard deviation, whichever is, if it is dominating, then that is a more efficient portfolio. So over here, this will give you, let us say, question number 21. Next, you go to question number 22. This is pertaining to the Tangency portfolio. So let us try to select. 3 investors are considering investment opportunities. The market portfolio lies on the efficient frontier. Okay, before this, maybe we'll have to discuss that capital market line concept. Only then will we be able to apply for this. So over here, what is happening is, like when we discussed about the efficient frontier, we said that, well, this is this combination, and let's say this is your efficient frontier, and let us say, if let's say your risk taking capability, considering that you'll have an indifference curve. So one of the indifference curves intersects. So this portfolio over here will ideally be your optimal portfolio for you. Now you might select this portfolio, and let's say Harry Markowitz says, like, this is what most of the big market proponents also say in today's time and age. They say that even Warren Buffett says that if you are not very clear on which stock to pick up, you just go to the market, you just go to the index and invest in that index and stay invested for a reasonably long period of time. In which case, if the country grows, if the stock market is increasing, well, you are going to make a return which is higher and a superior return. So you want an optimal portfolio that is based on your risk aversion. So you actually build up that portfolio. Let's say this is the market portfolio. You call this portfolio as, let us say, the market portfolio, for example. Now, maybe when you look at a capital market line, what is a capital market line? A CML, we have discussed this, we have even done a sum on this. When you look at a security market line, in case of a security market line, the appropriate measure of risk is beta, and in case of a capital market line, the appropriate measure of risk is the standard deviation, if you are aware. So on one side is a measure of total risk, that is standard deviation, and on the other side is a measure of return, which is, let us say, in percentage. Now let us say you have built up a portfolio, even at a zero standard deviation, even at a zero risk, you're going to earn the risk-free rate. So one of the points is definitely the risk-free rate. Now let us say you have an optimal portfolio, which is a market portfolio. Let's say your risk-free rate is 10%. However, let us say your market portfolio, at, let's say, market will also have some standard deviation. So let us say your return of the market comes to 15%, and let us say the standard deviation of the market is, let us say, 12%. Let's say this is based on the efficient frontier as well. So in the efficient frontier, you can see that over here maybe this risk comes to around 12%, and let's say the return over here is maybe 15%, and this is the optimal portfolio, for example. So over here you might say that, okay, at a 12% risk, you might make a 15% return. So maybe one of the points for this line may be 0, RF for the capital market line, that is 0, 10%, and one of the points can be maybe 12%. See, beta of the market is 1, standard deviation of the market is not 1. So maybe 12, 15, this is your optimal portfolio. So now over here, if you were to draw a line, maybe this line is called as the capital market line, CML, where on one side, see, for a line you need 2 points. One point can be 0, RF, even at 0 total risk or 0 beta, there will still be a return, which is a risk-free rate. And then in case of SML, you have 1, RM. In case of CML, you can have whatever is the standard deviation of the market, RM, and let's say that is coming over here. Now you take this portfolio. What Harry Markowitz says is, sometimes, now this is, see, market is very dynamic. You might, market meaning your stock investing is very dynamic. Now it is possible that if you only want to earn a 15% return, where you only invest all your money in the market portfolio and you have a 12% risk. However, it might happen that for whatever reasons, you want, now let's say there's a lot of geopolitical uncertainty, there's a lot of war, you want to reduce the risk that your portfolio has. Now one option is you keep on selling some of the shares, buying something else, and it might become a little confusing. So what does Harry Markowitz say? He says, let us say that if you are investing as a rational investor, let's keep it simple, let us not go into the stock selection and stock picking part. He says that we can look at a combination of the risk-free security and the market portfolio, and looking at that, we can vary our risk and thereby vary the return. Like now you are scared, now you're not okay bearing this 12% standard deviation because there is a lot of uncertainty in the market. You want to bear a lower risk, but if you want to bear a lower risk, well, you have a lower return as well. You are okay, you are saying that, okay, I'm okay with a return of up to, let's say 12%. So now for earning a return of 12%, maybe how much will be your weight? So over here, one can say if your return is 12%, you will have a combination. Now, if I put all my money in the risk-free security only, then I'll earn 10%. If I put all my money in the market security, I will get 15%. However, I want to earn a return. Let's not keep it 12, let's make it 13. So if I want to earn a return of, let us say, 13%, I will take a combination of the risk-free security and the market portfolio. So maybe I will take a weight of the risk-free security, that is F, into the return, that is 10%, plus weight of the market portfolio into, let us say, 15, and I will take an average over here. So over here, this is 0.13 equals, let us say this is 1 minus WM into 0.1 plus 0.15 WM. So if I open this brackets, it will be 0.13 equals 0.1 minus 0.1 WM plus 0.15 WM. So basically over here, you will take 0.03 on the left hand side and you will have maybe 0.05 WM on the right hand side. So weight of the market portfolio will be 0.03 upon 0.05, that is around 60%. So you will now keep 60% of, let us say, your investment in the market and maybe 40% in the risk-free security. So you will basically lend, that is invest in the risk-free security. So your optimal portfolio, well, you want a return of 13%. You are okay getting less than the market return because you want to bear a lower risk. How much risk? You will find the portfolio standard deviation as well. But over here, you are okay taking a lower return of around 13%. So you will pick up a portfolio which is called as the lending portfolio. Sir, why is it called as a lending portfolio? You will know in some time. What is happening over here is you will have a combination of the market which is at 60% and a combination of the risk-free security where you are investing, that is you are lending, you are giving money, you are investing at the risk-free rate which is 40%. So this is creating, let us say, a combination of 60-40 where you are 40 lending, that is investing in the risk-free security. So that is always the case? Well, not necessary. Let us say you now want to earn a return of 18%. Now you are greedy. You are saying I want to earn 18%, not greedy. I mean, you are ambitious. Let us put it that way. In which case you say 18%. Now, how will I earn 18%? Well, we still say that you will have a combination of the market portfolio and the risk-free. Harry Markowitz sticks to that. He does not go into the stock selection. He says, forget stock selection. You invest in the market portfolio, which is an optimal portfolio. And you just kind of play around the weights between the risk-free security and the market. Like over here, this is the weight of the risk-free security into 10% plus the weight of the market portfolio into 15%. Now this gives you an illogical conclusion because you're taking an average of 10 and 15. How will your answer come to 18? Let us see. Still mathematically, 0.18. Well, the total of weights is 1. So this is 1 minus WM into 0.1 plus 0.15 WM. So basically 0.18 will equal 0.1 minus 0.1 WM plus 0.15 WM, and hence this is 0.08 if I take, and this is 0.05 WM. Therefore, weight of the market is 0.08 upon 0.05. This is 1.6. Acha, but total of weights has to be equal to 1. Okay, so this means this is minus 0.6. And I don't know if you remember or not, but when the weight turns negative, it means that you are shorting. That is, you are selling these risk-free securities. So forget investing. You are in a way borrowing using the risk. So when I sell bonds, I actually borrow. When a company issues or sells bonds, they're in a way borrowing. So maybe if I want to increase my return beyond the market, but what I will do is I will in a way short the risk-free security, that is borrow using the risk-free rate, and in a way invest a higher amount than what I have in, let's say, the market portfolio. So that is why the securities on the other side over here, or the combinations on the other side above this, will be called as the borrowing portfolios. So is all of this very important? My answer is no. However, well, this is there in Harry Markowitz's theory. It is there as a part of the theory in your study material. And if they want to formulate a particular question, as long as you know this concept, I believe that you will be able to answer. And hence, we've tried to devise a couple of questions based on this as well. So over here, when we look at the capital market line theory, just a second, capital market line theory, over here the important point is on one side there is return, on the other side there is standard deviation, not beta. Now at the standard deviation of the market, you are earning the return of the market. This is SDM and this is expected return of the market. Let's say B is the efficient portfolio which is called as a market portfolio. Now over here I don't want to earn as much as 15. I'm okay. My targeted return is 13%, in which case I'll invest some money in the risk-free security and I will also invest some money in the market portfolio. However, I want to earn more than 15. Well, how will I earn more than 15? I don't have to do stock picking. I will just try to short the risk-free security and invest more, let's say 1.6 into, let us say, the market portfolio. So over here, the investment strategies, preferred investment strategies plot along with this line representing alternative combinations of risk and return. This is known as the capital market line. On one side you have the return, on the other side you have, let us say, the risk in standard deviation terms. Portfolios lying over here shall be, we can say, between RF to B shall be lending portfolios. It will involve some investment in risk-free securities and some investment in market. But portfolios lying between B to Z will be borrowing portfolios over here, because I'll have to short in this particular case by borrowing the same amount. So over here, we have done all of these as well. When you look at an CML, I think it was question 34 or something, where you say, well, RF plus RM minus RF, usually it is into beta. However, in case of CML, it is standard deviation of the security upon standard deviation of the market. And if I have to find a slope, this is RF plus RM minus RF upon standard deviation of M. This is like the slope of the CML, and you can find it is on the same logic as the CAPM, just that instead of taking beta as a measure of risk, you end up taking standard deviation as a measure of risk. So over here, if I apply that understanding and try question 22 as well as 23 and see if I'm able to apply if a question on these lines lands up. So three investors are considering investment opportunities. A market portfolio lies on the efficient frontier. So it is at a particular level of standard deviation, it is giving you an optimal return. The risk-free rate is 6% and the investors can both lend and borrow at this rate. Their preferences are: investor A dislikes risk and prefers stable return. Investor B is comfortable with an average market risk. So investor B should invest in the market portfolio only. That's it. There's no further need to deploy any money in the risk-free security, nor is it required to borrow at the risk-free rate. Okay. Next you have, there's investor C, who is willing to borrow funds to increase expected return. So basically investor C will have a borrowing portfolio where the weight of market will be more than one, and I will short sell the risk-free security, whereas investor A will create what is called as a lending portfolio. So you are required for each investor to identify the most appropriate strategy. Either invest partly in risk-free and partly in market. Well, this is a good strategy for A. Invest entirely in the market. Well, this is a good strategy for B. And borrow at the risk-free rate and invest more than 100% in the market. Well, this is appropriate for C. And based on that, you are asked to give reasons. So basically, this is question number 22. Next, you have question number 23. Capital market line and lending and borrowing portfolios. Two investors adopt different investment strategies. Rohan invests 40% in treasury bills, that is risk-free asset, and 60% in the market. So Rohan is having a lending portfolio, whereas Karan borrows funds at the risk-free rate and invests 140% in the market portfolio. So Karan, one can say, is having a borrowing portfolio. You are required to identify the lending portfolio, maybe Rohan's portfolio, borrowing portfolios, maybe Karan's portfolio. Which investor is expected to earn a higher expected return? I would say this is Karan. But this comes at the cost of higher risk as well. One will say that then let us go ahead and invest like Karan. However, it will have a much higher standard deviation as compared to Rohan's portfolio. Which investor is exposed to higher level of risk? Again, Karan. Yes, they are having a higher return, but there's also a higher risk. Explain why both portfolios will lie on the CML, capital market line theory. Like in the capital market line, it is a security with a higher return will command, or security with a higher risk will command a higher return. Security with a lower risk will have a lower return. That does not mean that there is only one optimal return on the CML. CML is basically a combination of you mixing your market portfolio with risk-free security and trying to optimize. So what Harry Markowitz again tries to say is, he says, forget stock picking and everything. Let us look at the market portfolio as a base. If you're okay with the same level of return, with the same level of risk, great. You don't need to do anything else. But if you want to decrease your risk, well, you should be okay with the lower return as well. You can do a lending portfolio where you invest some of your money in risk-free security. The remaining will be in the market portfolio. You'll have a lower risk, lower return. You're still on the CML. Or you want to increase your return, well, you should be willing to bear a higher risk, in which case you will borrow money at the risk-free rate and invest more, let's say around 140% in the market portfolio. So over here, both portfolios on the CML, because each portfolio is a combination of risk-free and the market tangency portfolio. The difference is the lending portfolio lies between the risk-free asset and market, and borrowing lies beyond the market portfolio through leverage. Okay, A moderate investor will invest in the market. A conservative investor will put a higher investment in the risk-free asset. An aggressive investor will borrow at the risk rate, invest more than 100% in the market. Okay, so this is question number 23, and I would say these are the 2-3 questions which can possibly make it to the exam in terms of the tangency portfolio, efficient frontier, lending. So these are the 3 or 4 terms which they can play around. Efficient frontier, similar theory of dominance, lending or borrowing portfolio, well, a combination of risk-free security as well as the market portfolio. And you have, for example, the tangency portfolio, where efficient frontier and your indifference curve kind of are tangent. They can make an MCQ, a theory, or who knows, a small descriptive or numerical based on that. So that now I think you should have a slightly better idea of these concepts. Okay, next you will have a REIT and InvIT. Now these days InvIT is going quite well in the market. So what is the difference? Like if I go on a theory side, when I look at real estate investment trust or something called as REIT, for all practical purposes, it is similar to a mutual fund. Like in mutual fund, you give money. Against that you get units, and the money is used by the fund manager to deploy in shares of companies. Here, instead of deploying that in shares, you will deploy that in real estate, in actual hard real estate, not real estate companies, not like DLF or Lodha or Oberoi, no, in actual physical real estate projects like let's say offices, commercial spaces, etc. And on that, these REITs will earn return in the form of rental yield and maybe capital appreciation of that property. So currently, for you to take exposure to real estate is usually very costly. If you go out and buy an office or something, it is extremely costly and most people don't have the resources. However, if they put money in a REIT, the REIT will buy these offices and you will get a share in, let us say, the rentals, or in let us say the capital appreciation of these particular assets. So that is REIT. The underlying over here is properties. Again, the REIT will give distribution like a mutual fund gives distribution, like whatever rental is collected, they can even distribute. And then is InvIT. InvIT has underlying as infrastructure assets, like for example, toll roads. Like there are a lot of InvITs, and these are very popular products these days, where what will happen is there will be a, let's say, like a mutual fund, there will be a fund which will have underlying, they will buy, instead of commercial office spaces, instead of companies, they will buy, let's say, projects like the toll roads, like ports, where there is going to be an income in the form of toll revenue, etc. And when you buy a unit in an InvIT, you indirectly, in a way, are owning that toll road. So if there's capital appreciation, which is relatively rare over here, but if it is, then you get a share in that. But I mean, these are usually government assets only. So largely, when you invest in InvIT, you are actually playing in that return that you're getting in the form of toll revenue, and you get a share in that. So whatever, like in a REIT, you get rental income. In an InvIT, you get toll revenue, and this income gets distributed, let us say, to the unit holder. So these are alternative investment products. In case something like this comes up, you should be aware. An investor is evaluating 2 investment opportunities: an infrastructure investment trust, also called as an InvIT, and a real estate investment trust, also called as a REIT. The following information is same as a mutual fund question only. Market price per unit is available. Annual distribution per unit is available, 12 and 4. And the number of units purchased is 500 and 200. Market price, annual distribution, number of units. Further information: the InvIT owns toll roads and power transmission assets, whereas the REIT owns commercial office buildings and shopping malls. During the year, both trusts distribute their entire distributable cash flow to the unit holders. So whatever they've earned, they will distribute. You are required to calculate the annual cash distribution received by the investor from the InvIT and the REIT. Like over here, this is 12 per unit into 500 that I am holding. So 12 into 500 comes to approximately 6,000 is the distribution under the InvIT, and 200 into 24, I think 4,800 is the distribution under the REIT. Calculate the distribution yield, that is distribution upon the market price, into 100 for both the investment. This is like the, I would say, there's hardly any capital appreciation, but let's say the return of 12 divided by 120. So this is probably 10% for the REIT, and 24 divided by 300, maybe 8% for the InvIT will be the return. Now these are higher than, let's say, a typical government bond or a fixed deposit. So over here this is 6,000, 4,800, 10% return, 8% return as a case maybe. Which investment provides a higher distribution yield? I would say it is REIT in this particular case. Again, if the unit value also appreciates, this 120 goes up or this 300 goes up, that will be considered. So I think, hold on, InvIT, not REIT, first one is InvIT, my bad. So InvIT or investment infrastructure trust provides a higher distribution yield of 10%. And the difference between the two is you have income generating real estate as the underlying, whereas here you have infrastructure asset. Again, income generating infrastructure asset like toll roads, transmission lines as the underlying. One key difference between a REIT and InvIT with respect to nature of the underlying assets, in case this comes in the exam. So this is what we have even discussed. So they've even given you a summary in case something regarding a REIT or an InvIT comes up. Okay, so this is question number 24. Next we have active versus passive portfolio strategy. Now, when you look at investment management strategies, an active fund manager, what they try to do is they try to deploy and select stocks in a way to outperform, let us say, a benchmark, like an index. Like let's say you are a large cap mutual fund, then you say that, okay, a corresponding benchmark is like Nifty, and I will not just look at the same stocks of the Nifty. I will try to figure out which stocks are undervalued, which are overvalued. I will accordingly try to invest. So this is an active fund. Whereas a passive fund says, well, you know what, the market is, it is very difficult to find undervalued securities because the market is efficiently valued. So I don't want to invest my time and resources in that. In fact, I will passively track or benchmark my return as compared to an index, let's say a Nifty's return. So this is a passive fund. So what is appropriate for whom? If let's say you are in a market structure where there are a lot of undervalued securities and opportunities are available, where you can pick up, do stock picking, well then active management is a good strategy. But active management is usually has a higher expense ratio, it has more cost. Whereas if you think that the markets are fairly efficiently priced, then what is the point of going and studying everything, and when you see that the fair value is almost efficiently priced, in which case you might as well follow the index, in which case passive strategy is more efficient. It has a relatively lower expense ratio as well. So when I look at active versus passive, Mr. X believes that the equity markets are highly efficient and that consistently outperforming the benchmark index is difficult. Mr. Y, however, actively analyzes securities and frequently revises his portfolio to earn superior returns. Okay, so one of them believes that the market is efficient, in which case ideally the appropriate strategy for Mr. X should be a passive strategy. Mr. Y believes that no, you can still analyze the securities, revise the strategy, continuously keep on rebalancing the portfolio, in which case for Mr. Y maybe the appropriate would be, let us say, for Mr. Y the appropriate maybe, let us say, the active strategy. Identify the investment strategy followed by each investor. Well, X follows passive, whereas Y follows active. Distinguish between active and passive, so it is more of a theory. So X follows passive, Y follows active. Active seeks to outperform the market, requires frequent buying and selling, requires higher research and transaction costs, and based on security selection. Passive, on the other hand, just replicates market returns, minimum portfolio changes, lower management and transaction costs, and based on index and buy and hold approach. Under which market conditions the passive strategy generally considered more appropriate? Well, in case markets are efficient and it is difficult to find underpriced securities, in which case it is better. When markets are reasonably efficient and consistently earning abnormal returns through active management is difficult. So this, I would say, takes care of the portfolio section. Largely, I would say a lot of portfolio is there in the numerical parts. They will not ask more. They can play around with the existing concepts of, let's say, CAPM, characteristic line, arbitrage pricing theory, which they've been asking recently, Sharpe's optimal portfolio, which has become a recent favorite. But these are all there, numericals are all there. Well, these few theory points regarding alternative investments, regarding possibly these 3-4 terms on which a question could have been built up. So we have just tried to run that through. Okay, then there is this chapter pertaining to risk management, where there is this questions of VAR which keep on coming either in an MCQ mostly or in a descriptive. So VAR is covered extensively in the numerical section, but there can be other risks in that chapter which we have done in the theory part. Like you have a country risk, like in today's environment geopolitical risk is a very important risk. Then you will have, let us say, crude oil prices changing, commodity price risk. Maybe you can have currency fluctuations, exchange rate risk. You can have interest rate risk if the interest rate regime is changing. Maybe in terms of let's say a lot of your assets being digital, cyber security risk. So a lot of these risks are there. Some of these risks are financial, like you have the exchange rate risk, interest rate risk. All of these are financial risks. However, there can be risks which are non-financial, like a cyber security risk or a geopolitical risk may not necessarily be a financial risk, and maybe a case study can be built up. And they've asked you a couple of case studies in the past as well. And by no means am I saying that this is the same case study that is going to come, but maybe on the other than VAR section, apart from a theory where they tell you about, describe about financial risk or let's say some price risk or country risk, which is there at a lot of length in your theory compiler as well as the video. Maybe they can also ask you a case study, which we are trying to review over here in terms of risk management. This is just an integrated risk management case study, which can act as a base for your thought process. So ABC is one of India's largest manufacturer of industrial machinery. The company exports nearly 40% of its production to Europe and USA, which means there's definitely an exchange rate risk which can be there. Like today, that is a very real threat with the dollar going the way it is going. During the current year, the management has identified the following developments. The price of steel and aluminium, which the company's major raw materials, have become highly volatile, which means over here there's a commodity price risk. Like usually when I look at crude oil in today's market, even copper in today's market, is the prices are very volatile. So that is a risk. Nearly 40% of export are denominated in US dollars, where certain are imported in US. So this is an exchange rate risk. Again, this can be managed by taking appropriate hedging using forwards, futures, etc. But these are financial risks. I would say exchange rate risk, commodity price risk. These are financial risks. Company has financed a recent expansion through a floating rate bank loan, which means floating rate means there's an interest rate risk. Again, this is a financial risk because if the floating rate jumps up, well, you have a risk. Company, the manufacturing plant is located in a coastal area that is frequently affected by cyclones and flood. Now, this is, let's say, I don't know, how do I, let's say this is a calamity risk or a location risk, physical or operational risk. Okay, let us word it well as an operating risk. Like if you're located in maybe Japan, there is a lot of risk of earthquakes. So that's an operational risk. Company has recently adopted a cloud-based ERP system, and management is concerned about increasing cyber security threats and ransomware attacks. So this is a cyber security risk. So these are non-financial. These are not specifically financial risks like interest rate, exchange rate, price risk. All of these are financial. These are non-financial. A proposed environmental regulation may require significant changes in the manufacturing process over the next 2 years. Again, this is like environmental risk and regulatory or compliance risk. This is also non-financial. So maybe this is compliance. You can think of these terms, and this is also a non-financial risk. One of the company's largest customers contributes nearly 30% of the annual revenue. So maybe you are very concentrated. If this customer walks away, a lot of these problems are happening with big IT companies. Big customers are walking away because of AI, and that if your customer portfolio is very concentrated, you are bearing that risk. So this is a concentration risk, which is also, let us say, a non-financial risk. Now, most of these risks, how can you mitigate? So identify the types of risk, classify financial or non-financial, suggest one appropriate risk management technique. See, for most of the financial risk, you can enter into hedging products or enter into swaps, like steel prices, commodity prices. Well, you will hedge using forwards. Foreign exchange risk, again, you will hedge using forwards. Floating rate, well, it is financial. Well, you can enter into swaps to swap your floating into fixed exposure. Then the non-financial risk is a little more difficult to manage. Most of them can be managed by taking, let's say, something like an insurance or disaster recovery planning. Again, security controls for cyber security, continuous regulatory monitoring and compliance should be done, and depends on customer. Well, you should try to diversify your customer base and reduce dependence on a single party. So maybe you can look at the question every point. You can try to identify which are the possible risks. You may not have the absolute same language, like there can be, you can say cyber risk or technology risk, physical risk or operating risk. So but you should be able to see that these are the various types of risks which are possible. Most of the financial risks can be managed using hedging or using taking swaps or other forward products. Non-financial risk can be managed by continuous monitoring, maybe taking insurance, maybe diversifying the portfolio, increasing your controls, etc. So this is maybe one case study which can be looked at in a risk management section, which is maybe slightly more different as compared to, let us say, your regular traditional VAR or your traditional description of theory risks. Okay, then going into the next major chapter, which is on foreign exchange. Now this chapter, the name of this chapter itself sends shivers. Arey bhaiya, foreign exchange, how will, thankfully over here in terms of the coverage, you will see majority of the things are already done. When you look at, let us say, the foreign exchange chapter only, there are 90 plus problems over here covering almost everything under the sun. However, there are a few other things which we could see from the study material on which maybe an MCQ or descriptive or maybe a numerical can be built up. So this is what we are going to cover over here. So let us get on into the topics pertaining to foreign exchange. First of all, this is regarding purchasing power parity. Now, we have done enough concepts, questions pertaining to purchasing power parity, but usually over here, we will try to review this into three main buckets. So over here, when you look at, let us say, your exchange rate theories, you will have the purchasing power parity theory. Now, what does the purchasing power parity theory? And there are two things which we have already done. There is something called as the absolute purchasing power parity theory, where you kind of say that how does the exchange rate actually get determined? Sir, the exchange rate gets determined considering the differences in price levels. Like we had taken, I think, the example of cricket bats or pens or something like that. And we have said that when you know what, when I look at, let us say, the price of a basket of goods in India, how much does it cost? Let's say a basket of goods in India costs 1,000 rupees. And a similar basket of goods in the US, how much does it cost? Maybe a similar basket in the US costs you $200, $300, or let's say $20, $30, whatever is, let's say $20. In which case, if A is equal to B, let's say if A, that is 1,000 rupees, is equal to a basket of goods, if that same basket of goods is equal to C, let's say that is $20, then the exchange rates are 1,000 rupees is equal to $20, that is maybe rupees 50 per dollar. So this is, let's say, your absolute purchasing power parity theory, where you say that your exchange rates are determined due to differences in the price levels, and this is something that we have done. But there is an adjustment that we need to do over here. And then there was a more important relative purchasing power parity theory, which was also called as the inflation rate parity theory, where you would say that F divided by S equals 1 plus I, let us say in rupees, upon 1 plus I, let's say in dollars. Half of your foreign exchange is following this. So this is relative purchasing power parity theory, also called as the inflation rate parity theory, which is what is done. Apart from that, there was also an interest rate parity theory. But before that, when you look at an absolute purchasing power parity theory, we say that you look at the price level in India, let's say the domestic price level, let us say in India, and you compare that with the price level in the foreign country, let us say that is the US. Like for example, if a basket of goods costs you 1,000 rupees in India and the similar basket of goods costs you $10 in the US, then we would say that probably the exchange rate should be rupees 100 per dollar. However, this is a pure purchasing power parity theory. The problem over here is there is a possibility that there may be certain, I mean, you're assuming that it will cost you the same to buy that product in India or in the US. Well, it will not. Well, with let's say Trump being around, there'll be a lot of tariffs, there'll be some transportation costs, there'll be import duties, there'll be a lot of these things that will come together, and hence this is not something which is directly comparable, and hence an adjusted purchasing power parity theory, which is what we want to see. So over here in an adjusted purchasing power parity theory, there may be other costs, like for example, there can be import duty, there can be let us say tariffs, and all said and done, you try to make it comparable. And based on that, there is a term called as a sectoral constant or something like that, a sectoral constant which will be calculated, which is like an adjustment factor. And considering that, we will try to find, let us say, the exchange rate. Sir, over here, if I look at, let us say, a particular numerical, and on similar lines, there is a question as well. So over here, I think when I look at purchasing power parity, we will say that this is from 10.18 of your study material. Purchasing power parity focused on inflation and the exchange rate relationship. There are two forms. One is the absolute form, where they say the law of one price, which suggests the price of similar products of two different countries should be equal when measured in a common currency. So they should cost you effectively the same. It is just the difference is due to the different currencies. If a discrepancy in price is measured by a common currency exists, the demand should shift so that these prices should converge. We have done this at a lot of length, so I'm not doing that right now. What we are doing now is this: an alternative version of the absolute form that accounts for the possibility of market imperfections, such as transportation cost, tariffs, quotas, embed the sectoral constant. So sometimes there can be an MCQ, there can be a small question where you might be asked to solve for the sectoral constant. So what is sectoral constant? It suggests that because of these market imperfections, the price of similar products will not necessarily be the same. Like there can be import duties, tariffs, quotas, etc. And hence you find an adjustment factor which is called as a sectoral constant. We show this something similar to an alpha when measured in a common currency, but it states that the rate of change of these prices should be somewhat similar when measured in a common currency, as long as these remain unchanged. So when you look at the spot price, well, typically we say spot price is rupees 1000 divided by $10. That should be 100. So this is price of the domestic upon price of foreign into alpha. Now what is alpha? Alpha is the sectoral constant, and this is why we are doing this. What do you mean by a sectoral constant? It is a sectoral uh, adjustment. Like a cricket bat sells in India for 1000, the transportation cost of one bat from Ludhiana to New York costs 100 rupees, and import duty levied by the US on cricket bats is 200. Maybe that means the effective price in the US is not 100,000, it is probably over here 1000 plus, let us say, 100 rupees, because maybe there will be some transportation cost, plus let's say effectively there will be 200 of duties that needs to be paid, and hence the actual comparable to the Indian price is 1300, and hence a sectoral constant, if I have to calculate, would be 1000 by 1300, and hence 0.762. Now this is not given in a very proper way, so what we have tried to do is we have tried to formulate on exactly similar lines a numerical. So if I look at question number 32, including the effect of the sectoral constant, I want to find the rate considering these market imperfections. Other than that, in general, we had just discussed that there can be market imperfections. However, if I want to quantify the rate considering those market imperfections, so this is a good numerical which can be probably looked at. So if I review the absolute purchasing power parity theory, ABC Exports, an Indian manufacturer of a premium cricket bat, exports its products to the United States. The management wishes to estimate the equilibrium spot exchange rate between the Indian rupee and the US dollar using the absolute purchasing power parity theory. The following information is available. The selling price in India is 1000, in New York is $10. The transportation cost from again Ludhiana to New York is 200 rupees per bat, and import duty is around 100. Which means if I look at determine the equilibrium spot exchange rate, show the necessary workings, and briefly explain the significance of this sectoral constant. This can come in an MCQ and you should be able to solve. So when we are looking at, let us say, this working, we will have, let us say, a value which is 1000 plus 100 plus 200. So this is 1300. This is the equivalent price in the US. Your calculation is the price in India upon the price in US. US you take in dollars, but the US price is around, let us say, $10. Now you equate this $10 rightly to 1300 and not to 1000, and hence you do 1000 divided by 1300. This comes to around 0.769 or something, 7692. So if the question comes to calculate a sectoral constant, it will be the Indian price plus the rupee adjusted price considering transaction cost. So this is 0.7692, and the formula for finding the spot rate is the sectoral constant, which is 0.7692 into the price, let's say, of rupees 1000 upon, let us say, $10, and hence this comes to around 76.92 per dollar, which will be over here the spot rate. So this covers, let us say, this adjustment for absolute purchasing power and the significance of sectoral constant. This can be helpful for a small theory question or a point. This will only be relevant if there are market imperfections. If there are no market imperfections, then 1000 divided by 1000, that is 1. But if there are market imperfections, to account for those market imperfections, we calculate this sectoral constant. Adjust for transportation costs, import duties, tariffs, and other market imperfections. It recognizes that identical products may not sell at exactly the same price in different current countries because of these additional costs, and accordingly we find an alpha which modifies the absolute purchasing power parity to prove a more realistic estimate of the equilibrium exchange rate. Okay, so over here we are looking at, let's say, this adjustment. I would say this is important because a numerical can be coming or a sectoral constant can be asked for the perspective of absolute purchasing power. So this will be, I would say, relatively important. Next, you have a theory which is called as Fisher effect, and maybe a short note or a numerical on that can come. And we have done this, I would say, in indirect way. Like for example, when we even look at the efficient frontier and theory of dominance is one and the same. But let's say if it comes as a particular term, that should not kind of affect you. Like when we look at interest rate parity, we say interest rate parity theory. We do the same thing. We say usually countries where inflation is high, interest rate will high, and hence F divided by S equals, let's say, 1 plus R. Let's say this is the rate in India, and upon 1 plus R, let's say this is the rate in the US. And you also have this covered interest arbitrage principle that kind of says that the interest rate parity has to apply. We've done enough numericals on this. Now, what do you mean by the Fisher effect? So over here, what is important is when you look at the absolute purchasing power parity, over here there'll be an alpha, and that is the sectoral constant, and the alpha over here is calculated as the price. Let us say, how do you calculate the alpha over here? Well, let's say the price in domestic upon the adjusted price after considering, let us say the necessary costs. This will be your sectoral constant. In a similar way, we will study what is called as the Fisher effect. And in the Fisher effect, there are actually two effects. One is the domestic Fisher effect. Now, the formula for the domestic Fisher effect is the same as what you study to find the nominal rate from the real rate. So what does Fisher say on a domestic level? Even if there is no exchange rate, they say, how we have done this formula multiple times. Like, how do I find the nominal rate? We will say, well, the nominal rate is 1 plus the real rate into 1 plus inflation. Do you guys remember doing this? Well, this is something that you must have definitely done. So you'll have 1 plus the nominal rate into 1 plus inflation, and this into 1 plus inflation, and this will be. So a nominal rate is higher in a country where inflation is higher. A nominal rate is lower where inflation is lower. So this is what we have done multiple times. This is, if they tell you show the working as per the domestic Fisher effect, well, this is the working as per the domestic Fisher effect. Now, when you look at the international Fisher effect, what does Fisher say? Fisher says that he believes that the real rates across the world are the same. Well, the differences across the world are the same. So which means if there's a difference in interest rates in US and India, that is largely not because the real rates in the US or in India are different. It is largely because the inflation is different. So if the real rates are the same across the world, then the differences in the nominal rates represent differences in inflation. So over here, we can say the nominal rate differential, whatever it is, will approximately equal due to the inflation differential. However, we have also studied using IRP, interest rate parity, or inflation rate parity, that is also equal to approximately the exchange rate differential. So like a forward discount or premium that you calculate over here, we say that one currency is at a premium as compared to the other currency because its inflation or interest rate is lower. So over here, which is approximately equal to the forward premium / discount. So this is basically the exchange rate differential. So the Fisher effect, in a way, internationally, In on a domestic level, he says that how do I calculate the nominal rate or how do I derive the real rate? Well, 1 plus the nominal rate is equal to 1 plus the real rate into 1 plus inflation, perfect. Then he goes on to say on an international level that the real rates across the planet are going to be largely the same, and because the real rates are same, there's no incentive for me to invest in one country as opposed to the other, because ultimately if I consider the differences, they are largely due to inflation, and since exchange rates are going to change in tandem with the inflation, then the benefit that I can possibly get by investing in some other current country because they have a higher interest rate will be eroded, because the exchange rate will change approximately by the same proportion. So basically the ultimate conclusion of a domestic Fisher effect, which is taken into international Fisher effect, is the differences in, loosely speaking from a student standpoint, the interest rate differences are almost equal to the inflation differences, because the real rate across the world are the same, and those inflation differences are really the cause of the exchange rate differences. So the exchange rate differences will be the same, and hence there is no real incentive in investing in, let us say, other country because there is a higher interest rate. So you can predict the exchange rate difference in percentage looking at, let us say, the inflation or the interest rate difference. So this is regarding, let us say, when I look at the Fisher effect. So when I look at here, they have only given you the international, but there's also domestic Fisher effect. If you find, uses interest rate rather than inflation rate differentials to explain why exchange rates change. But why does interest rate change? Well, interest rates change, real interest rates are the same, so they change because the inflation changes. But it is closely related to the purchasing power parity theory, because interest rates are often highly correlated with inflation rates. Now, according to Fisher, nominal risk-free rates contain a real rate and an anticipated inflation. This means that if investors of all countries require the same real return, interest rate differentials between the countries may be a result of expected inflation differential. So maybe you can use these theory points to find an equation where we said that the price difference, that is the inflation difference, equals to the interest rate difference equals to the exchange rate difference. So basically what Fisher says is, loosely speaking, and again, this is, I think this formula is not very correctly devised, because they have taken the difference. Difference is 10 minus 2, 10% minus 2%, that is an 8% difference, but the differential is 1.1 upon 1.02. So this is, let us say, a differential, but institute, like over here, this is in a way 1.0784, that is 7.84 differential. Now, in my opinion, this is what is correct, but they have shown this based on a difference, and hence we have also formulated a numerical based on difference. So essentially, when when I look at Fisher effect, maybe there can be a theory that can question that can come on either a domestic Fisher effect or international. If it comes for domestic, we will just say that the nominal interest rate in a country is a product of the real rate and the anticipated inflation. Once you go to the international level, you will say that, well, you know what, across the world, the real rates are expected to remain the same. And as a result, the differences in interest rates are due to anticipated differences in inflation. And that is what is the base for purchasing power, which says that the exchange rate is different because the inflation is different, and as a result that will also showcase a difference in the exchange rate. So basically, if I try to see a numerical where in one question I try to integrate all of these, the inflation rate parity, interest rate parity, domestic Fisher effect, international Fisher effect, so there's one illustration which covers all of this, and this can be helpful. So over here, an analyst is studying the relationship between inflation, interest rates, and exchange rates in India and the US. The following information is available. So you have the real rate of return given and the expected inflation in India and the US. So as Fisher says, internationally, the real rate across the planet should be the same. The current spot rate of exchange is rupees 84 per dollar. You are required to determine the nominal interest rate in both the countries using the domestic Fisher effect. So over here, if I look at let's say India, I would say 1 plus 0.03 into 1 plus 0.06. I mean, I want to find the real, so 1 plus R. I will subtract the 1 over here, 1.03 into 1.06 minus 1. So maybe approximately 9.18%. In the US, it will be 1 plus 0.03 into 1 plus 0.02. Again, minus 1. 1.03 into 1.02 minus 1. This is around 5 point. 0.06%. So here they're just saying using domestic Fisher effect. So if a word like this comes, again, you should not be taken aback. You would have done this calculation almost certainly, right? So this is, let's say, the domestic Fisher effect using the relative purchasing power parity theory. Estimate the expected spot exchange rate after 1 year. Now, this is a question where you have to ask that should I take, sir, I will take inflation. Purchasing power does not take interest, it takes inflation. So forward upon, let us say, rupees 84 per dollar into, let us say, 1 plus the inflation in India is rupees per dollar, to inflation in the numerator of India and in the US denominator. So this is 84 into 1.06 upon 1.02, around 87.29. I mean, you should take more decimals, but let's say if I restrict this discussion to 2 decimals, let's say this is around 87.29. Okay. Next, you look at interest rate parity, determine the 1 year forward exchange rate. So again, you will take interest, or which interest? I will take the nominal interest, nominal, not real. Real is the same. So this is 0.0918 upon 1 plus 0.0506, which comes to again 84 into 1.0918 upon 1.0506. Again, if you go to see, this is 87.29 only. So as Fisher rightly predicts, I mean, you can take either the interest rates or you can take the inflation rate, you will get approximately the same answer. Using the international Fisher effect, estimate the expected percentage change in the spot exchange rate and hence estimate the expected spot rate after 1 year. Now, when I look at the international Fisher effect, what will happen? I will try to say that, well, what is the difference in interest rates? Well, that difference is largely due to inflation. He does not use inflation directly. The question, I mean, we have read clearly that Fisher looks at, let us say, the interest, and ideally I should look at inflation differential. In my limited understanding, I should look at the inflation differential, but institute, if you see the formula, they had taken directly the difference. So if I were to keep it consistent with the ICAI working, I would say rate in India minus the rate in the US. So this is the difference, will be equal to the change in the spot rates. So if I look at the rate in India, which is 9.18%, minus the rate in the US, which is approximately which is 5.0, what is this? I think 5.06 or something percent. So this will be around 9.18 minus 5.06. This is around 4.12%. So basically the change in the spot rates is likely to be 4.12%. Now the rate is given as rupees per dollar. So over here the interest rate in dollar is lower, the interest rate in the rupees is higher, and hence the rupee will depreciate against the dollar by approximately 4.12%, depreciate by 4.12%. So this is what Fisher kind of says, that if your current rate is rupees 84 per dollar, it will depreciate by around 4.12. This is will give you, I'll give you an exact answer as well, but if I want to keep it consistent with the institute's printed formula, at least I will come to 84 plus 4.12% will come to around 87.46. Now this is approximately equal to around 87.29 that I found in the earlier working. However, ideally, if I want to do it very accurately, instead of taking the difference, I will take the differential. So I will say that as per international Fisher effect, the forward and spot differential can be equated approximately to the interest rate differential. So this is 0.0918 upon 1 plus 0.0506. So it is same as the IRP. The formula will be the same, which means F will equal over here 1.0918 upon 1.0506. So maybe the adjustment will be 1.0392. Adjustment to what? Well, to the spot rate, which was rupees 84 per dollar. If I take this on the other side, this is F is equal to rupees 84 per dollar, to which I will say that the adjustment will be 1.0392, and see your answer will be exactly the same. So basically the formula of, actually if I go to see, this is rupees 87.29. In my opinion, this is the right formula. Even if you see online, and if you ask, let us say, maybe AI, they would, or even if you see online on the papers, you will find that even the theory mentions differential, and differential is, let's say, 1.0918 upon 1.0506. Mathematically, difference is 9.18 minus, let us say, 9.18 minus 5.06. But if you want to keep it consistent with the institute working, this is how it will appear. There will be a slight difference. You will say here it is 1.29. However, in my opinion, and so this is difference, nominal interest rate difference. This is not differential. This is actually difference. But ICI is given the formula like this. So according to the IFE, the currency of the country with a higher nominal rate is expected to depreciate, that is rupee will depreciate, by the interest rate differential. Therefore, approximate rupee depreciation is 4.12%, and hence you will come to 87.46. Ideally, what we will do is we will take the differential. And if I take the differential, I will say that the differential over here is 1.0918 upon 1.0506, which is 1.0392. And therefore, the forward rate will be the spot rate, which is 84, into 1.0392, which will come to exactly 87.29, which is the more accurate version. But if you want to keep it consistent with the printed formula, which is there in the institute material, well, you will do it the way it is given here. Comment on the relationship between the results obtained in B, C, and D. They should give you largely consistent results. Like the domestic Fisher effect shows the relationship between the nominal rate from the real rate and expected inflation. Relative purchasing power parity theory looks at inflation differential. Interest rate parity theory looks at interest rate differential. And the Fisher effect says that the currencies of countries with relatively higher nominal rates are expected to depreciate because those higher nominal rates are generally because of higher inflation, not because of a difference in the real rates. And the results obtained by these are almost close. They, if done accurately, are broadly equal. So this kind of looks at two important points, the purchasing power parity, and it also looks at the Fisher effect if it comes in the exam, whether it is a domestic Fisher effect, whether there is an international Fisher effect. Next comes the concept of something called as a currency coupon swap, CCIRS, but it is usually, because of the name, it is named as a Circus swap. So over it's strictly CCIRS, that is, IRS is the interest rate swap and CC is the currency coupon swap. So over here, what do you mean? See, we have done sums which are pertaining to pure interest rate swap. If you look at the interest rate risk management chapter, you had a loan which is a floating rate loan. You had another loan which is a fixed rate loan. Well, one party wants to move out of floating rate, so they kind of enter into a swap where they agree to pay the fixed and receive the floating. So multiple questions in interest rate chapter covering the interest rate swap. So you are just looking at the interest rate. A few questions in the currency chapter where you look at a cross currency swap where you are, let's say, looking at borrowing in India. Let's say there is a US company wanting to borrowing in India, an Indian company wanting to borrow in US. So what they do is, maybe an Indian company can take favorable terms in India, a US company can take a favorable terms in, let us say, the US. So the US company can borrow in the US, give that money to the Indian company. Indian company can borrow in India, give that money to the US company, so they can borrow at relatively favorable rates and they get the desired currency as well. Now, when you look at a Circus swap or a currency coupon interest rate swap, what happens is one party who wants a borrowing, for example, in another currency, and they want to swap it. So there will be a fixed / floating as well as currency, both legs that will be involved. Like for example, if I look at a case, I may have borrowed in US dollars at a fixed rate. So over here, if I look at this question as a numerical, it is manageable. Just that if it comes as a Circus swap, you should not be surprised. So over here, just a second. I think my pencil has stopped working and so has our mind. So I think we can continue now. So if we see over here, you have ABC who is in India who has borrowed USD $10 million at a fixed rate of 5% per annum. So I am an Indian company who is borrowing $10 million at a fixed rate of 5% per annum. Now, In a interest rate swap, in a just interest rate swap, I will probably swap this 5% into floating. That's about it. If I want floating exposure, if it is a currency swap, I will keep and swap this dollar against the rupee. In a Circus swap, I'll do both. That's about it. That is just about it. So if I look at the teeny tiny theory which is there in the study material, which mentions about this swap per se, Circus swap, which is exactly this much paragraph which is given. Now you can solve this as if it is a regular question, just that if they position this as a Circus swap or CCIRS, you should know what this means. A more complex version of a typical currency swap is a currency coupon swap, where swap a fixed or a floating rate interest payment, like in this case a fixed payment of 5% in one currency, let's say US dollar, for a floating rate payment in another, let's say in the Indian rupees. This is called as a Circus swap. That's about it. So if I look at a numerical on this, let us see if we are able to solve. ABC has borrowed USD 10 million. It's like a typical swap question. There's nothing new per se over here. Like you have absolute purchasing power parity, there's something new. Even in feature effect, there's something different that we see here. It is just repackaging. Since the company expects most of its cash flows in the Indian rupee, it wishes to convert its foreign currency fixed rate liability into an Indian rupee floating rate liability. So you're changing the currency from dollar to the rupees. You're also changing the uh, interest rate base from fixed to, let us say, floating. Accordingly, ABC enters into an arrangement with XYZ banks. The terms are ABC will pay INR MIBOR plus 1% on 830 million, and ABC will receive a fixed interest of 5% on a USD principal of 10 million. The spot exchange rate at inception is 83. Now, literally, in case of a currency swap, you will exchange the principals as well initially as well as at the end. However, let's see what is asked. Principal exchange will occur only at maturity and is ignored for the current year settlement. At the end of year one, MIBOR is 7% and the spot rate is 84. You are required to compute the annual interest payable by ABC under the INR floating leg. So under the swap, ABC is going to pay INR floating, MIBOR plus 1%, MIBOR is 7. So 7 plus 1%, that is equal to 8%, and 8% into around 830. So this is 830 into 8%, maybe 66.4 is what we are going to pay. Compute the annual interest receivable by ABC under the fixed leg. Well, this is 10 million into, I believe, 5%. This comes to 0.5 million. This is 10 into 5%. This is 0.5 million. But this is going to be received at the end. And at the end, the rate is rupees 84 per dollar. 0.5 into 84 comes to around 42. So you will receive a rupee balance worth 42 at the end. Convert the USD interest into INR at the year-end exchange rate and determine the net amount payable or receivable. Well, I will have to pay 66.4 and I will receive 42. So maybe the net, I would say 24.4 is the net payment that I will have to make. Based on the above arrangement, determine whether it qualifies as a Circus swap. We would say yes, because I am changing the currency from, let's say, dollar to rupees, and I'm also changing the interest nature, that is from, let us say, a fixed exposure to a floating exposure. Justify your answer by identifying the features that satisfy the Circus swap. So over here, let's say you will pay 66.4, you will receive 0.5 million. If you convert this into rupees at 84 rate, this will be 42, and hence the net settlement will be the difference between these two, which comes to around 24.4. And this meets the definition of a Circus swap, essentially because there are two different currencies involved. There's one fixed rate and floating rate, and the arrangement converts a fixed rate foreign liability into a floating rate domestic liability. So it meets the definition of a Circus swap, where a floating or fixed rate interest payment in one currency is exchanged for a floating payment in another. So this is essentially pertaining to this question number 34. Question number 35 is, in a way, this question is a little incomplete over here. Maybe in one of the earlier editions that I might have sent on Telegram, if you have this, there are a few statements which are missing over here. So, I mean, if possible, I'll share this separately again, or you can just focus on your screen. This is pertaining to selection of an appropriate foreign exchange management strategy. Now, what do you mean by foreign exchange management strategy? Essentially, your foreign exchange management strategy is divided into 4 parts. Like, you can make an axis and try to figure out, let us say, the parts of this strategy. Like, you can decide to keep everything unhedged, or you can decide to hedge everything. So these are the two extremes. So over here, if I were to create, let us say, a matrix, I would say that, well, you know what, over here, there would be, let's say, low risk, but there would be no low reward as well. Okay, if I just show that over here, maybe this is low reward, low risk. So let us say if I look at low reward over here, and let us say this is low risk, the opposite will be at the top, there will be high risk, and on this side there would be high reward. So there are four ways you can manage your foreign exchange exposure. Either you decide to hedge everything under the sun. So whatever is your foreign currency exposure, uh, you will hedge everything. In this case, you will get low reward and there will be low risk. There will be low risk because you're hedging everything. But because you're hedging everything, even if you're having an adverse rate, let's say banks are quoting very high forward rate, you don't care, you directly hedge. So you're not selectively deciding what to hedge, what not to hedge. So maybe if you hedge everything, or your policy is to hedge everything at whatever is the available rate, not selectively decide whether it is worth hedging or not. A lot of questions that you studied in foreign exchange required you to selectively decide whether it was worth hedging or not. Here you're not seeing that. Your policy is to hedge everything at whatever is the rate available. So maybe you're having a lower risk, great, but you're also going to get a lower reward. So over here, all exposures, if they're hedged, that will give you a lower risk, but at the same time a lower reward. The entire opposite extreme over here would be to hedge nothing at all. Now, if I hedge nothing at all, I will definitely have a high risk, but that does not mean I will get a high reward. Well, if I hedge nothing at all, there is a very high possibility. Well, the risk is high because I'm not hedging, but the reward does not mean it is going to be high. So this is probably hedge nothing at all. Sir, how? Well, I'm hedging nothing. So the risk is high, uncertainty is high, and maybe there might be rates which may change opposite, and hence my reward will be lower. So all exposures left unhedged, this will be high risk and probably getting low reward. Now, on the other side of the matrix, there would be other strategies where you would decide in maybe selectively hedging. Now, ideally, this is the best strategy where you will selectively decide whether it is worth hedging right now, and if it is, the risky ones you will directly hedge, and where required you can keep the exposures unhedged. So I would believe selective hedging would be, in my opinion, the ideal strategy, but it depends on the company's treasury manager, etc. So selectively trying to hedge, so your risk is low, but your reward can be possibly high because you can keep those exposures unhedged where you think hedging is costly, and hence you might earn a higher reward. And the last one is you are doing active trading. Like there are, let us say, contracts which you enter, then later you decide I want to cancel them if cancellation. So you keep on, let's say, managing, for which you need a very robust treasury team. There will be a lot of transaction costs. So maybe it might give me a high reward, but it can also carry a relatively higher risk. So basically there is a bit of explanation if you see on your study material on page 10.53 and 54 about these four different strategies. I don't see a question always necessarily coming. There is a theory question which is there, I think, in your compiler, question 11. But based on that, if I want to formulate a numerical, I would, you can just focus on this updated question set, and it will have, let us say, the data. So if I look at question number 35, this is, I think, in your sheet, this might be missing. If you have an slightly incomplete version, it's my mistake, my bad. These points were not printed. If I review question 35, a company exposed to foreign exchange risk can adopt different exposure management strategies depending upon the risk appetite, financial strength, treasury expertise, and outlook on future exchange rate movements. So considering all of these, there can be different possibilities. The board of directors of XYZ is evaluating 4 different approaches suggested by its executives. Each executive recommends a different philosophy for managing foreign exchange exposure. Read the following proposals and answer the questions that follow. Sir, what are the questions? Identify the foreign exchange exposure management strategy. Exposure management. So is it, let us say, all unhedged, all hedged, selective hedging, active trading, and based on that, identify the risk and reward. State the corresponding risk reward category, low risk. In my opinion, this is classic. I'm sorry, I think the screen had frozen. In my opinion, this is classic MCQ material. So in an MCQ, you can be asked, let us say, these multiple things, and hence this is classic MCQ. So whether it is low risk, low reward, low risk, reasonable reward, high risk, low reward, and so on, and give one reason why management may adopt that strategy. So maybe they may not ask you a theory question, but for sure this can come for an MCQ. So let us review. Executive A, we should hedge all our foreign currency exposures. All. The primary objective should be to eliminate uncertainty regarding future cash flows. Even if favorable exchange rate movements could result in gains, certainty should be given priority. So over here, this will be all hedging, and this will result in, let's say, lower risk, but it will also carry a lower reward. Okay. Executive B, we need to hedge. We need not hedge every exposure. Okay. We should hedge exposures where risk is significant, but selectively leave some of the exposures open where our analysis and exchange rate forecast indicate a favorable movements. This will allow us to balance the risk protection with potential gains. I would say this is selective hedging. And when I look at selective hedging, my approach should be giving me a low risk still, but this can give me a reasonable or even in certain cases high reward. So this is, let's say, for the second executive. The third executive, the company should generally avoid hedging altogether. It's foreign exchange exposures. Hedging involves cost, administrative effort, continuous monitoring. We should have exchange rate movements to take the natural course and avoid unnecessary intervention, in which case there is no hedge, in which case there is definitely high risk and low reward. This is, in my opinion, the worst of all the strategies. And last executive, the Treasury Department should actively take positions based on expected exchange rates. Apart from managing existing exposures, we should even actively exploit market opportunities like arbitrage, like for example, cancellation, etc., and generate additional profits from favorable movements. So this is active management, and this is maybe high risk because there will be speculative positions that you might take. And probably over here, if I look at the situation, there can be high reward, but for that high reward, you are bearing a high risk as well. So these are the four possible movements which you can look at and give one reason why they might adopt this strategy. So if the first thing is they prefer certainty, if they want to take measured risk exposure, we want to avoid hedging cost, and wants to optimize their treasury function to generate active profits, like for example, what traders do. So these are the few additional questions which one can say which is there. But apart from that, I also want to discuss a few additional theory points which may be there in case of this chapter. Like there are a few terms, they're not as significant. However, something that you should be aware, like in interest rate, how do you have the concept of basis points, bips? In a similar way, in exchange rate, there can be a concept of pips. This is on 10.11. What I mean, it just means is that if your rate is 686.3156 per dollar, the change, the lowest unit of change will be rupees 0.0001. This is called as 1 pip. So sometimes a question might give you a term like a pip. What is a pip? This is a price interest point. That means the smallest unit by which a currency quotation can possibly change. So over here, maybe if it is given in 4 decimals, the smallest unit by which it can be changing is 0.0001. That is equal to 1 pip, for example. Now there is American and European terms. Well, we would have heard about this in derivatives. Like American is an option which can be exercised anytime. European is an option which is exercised at expiry. However, when I look at, let us say, exchange rates, what do you mean by an American rate? Let us say an American rate is a rate which is given in, let us say, per unit of the other than dollar currency. So dollar per rupees will be an American rate, dollar per euro will be American rate, dollar per Canadian dollar is an American rate. However, when you look at a European rate, this is the rate which is, let us say, per unit of dollar. Just remember, most of the rates which are quoted are European rates. These are per dollar. Dollar is the global currency. So over here, quotes in American terms are rates quoted in amounts of US dollar per unit of foreign currency. So per unit of rupees or euro or Canadian dollar. So how many dollars per, let us say, other currency, whereas European rates are in amounts of foreign currency per USD. Per USD are known as European terms. So this is just kind of a reference. We usually look at direct quotes, indirect quotes. We don't really have these American terms, European terms or a PIP, but if something like that comes up, you should be aware. Merchant rates are like the wholesale rates which are quoted by banks to, let us say, their customers. And there are few of the theory points that we say. There is a concept of non-deliverable forward on which there is a sum also in a couple of RTPs back, which was a very complex question. We would have done this, I think, it was in September 25 RTP, the South Korean won to the US dollar question. What is a non-deliverable forward? Usually forwards are delivered and futures are net settled. So non-deliverable forward is in a way a contract which is usually taken against currencies which are not frequently traded. So the bank might not keep a stock of these currency like the South Korean won. Maybe Indian banks will not keep a stock for that. However, you can have a contract which can be like a futures contract which is exchange traded. This is not exchange traded. However, you can have a contract where the settlement can happen on a net basis. So you don't have to necessarily buy the won, pay the rupees. The banker does not have to arrange that won. No, the settlement can be using the difference in prices between an agreed rate and let us say the rate on the date of settlement. So this is like a futures contract only, just that there is not going to be a physical delivery. In fact, due to so much fluctuations that had happened in the exchange market, RBI had for a brief period even banned in India the non-deliverable contracts because that was resulting in additional speculation. So over here, a cash settled short-term forward contract, a cash settled short-term forward contract on a thinly traded or a non-convertible currency, where profit and loss is calculated by taking the difference between the agreed upon exchange rate and the spot rate at the time of settlement. This is a non-deliverable forward. Then there is also a concept of rollover of a deliverable forward contract. Now, what do you mean by rollover? Now, in case of a rollover, it is for all practical purposes like extension of a forward contract. Like you have the fate of forwards. In that fate of forward section, you will have things like cancellation, early delivery, etc. But there's also extension. Now, instead of extending specifically on the due date, you can even roll over this contract for another 2 months. For all practical purposes, it is similar to extension. So there will be a hidden cancellation and a new forward contract. So if a question comes where they tell you that a forward contract is rolled over, well, you will solve it in the same way. Means spot cancellation and booking of the new contract for a later date. It is similar to extension of the contract. Now, I mean, we have done IRS USD floating to fixed. IRS USD is the interest rate swap in dollars where we are just changing from floating to fixed. And then there was Circus swap. Now, there was one particular problem which we want to kind of discuss upon, which is on, I would say, the fate of forward section. So there are a few problems in the institute study material as well pertaining to the fate of forwards. This is between 10.33 to around 10.43, around 10 pages. If you want more practice on fate of forwards, we have done quite a few sums in the class. You would have also done those practice from wherever you have done. But if you want to practice more, there are around a few questions in this fate of forward, which can include extension, cancellation, early delivery, late/automatic cancellation. All of these are covered. Now, the problem over here from a student standpoint, where there is a kind of a let's say not so much clarity, is in all of these questions. If you see, the institute, what it has done is it has rounded off the rates to the nearest 0.0025. Now, this is as per the FEDI, Foreign Exchange Dealers Association of India guidelines. Now, this is done in the study material. The problem is in similar questions that have come in the past in the exam or in the RTPs or even in the older materials, this rounding off to 0.0025 was not necessarily done. So this opens up the question that if it comes in the exam, do I have to round off the rates to the nearest 0.0025? Unless it's a fate of forward question, I would say no. even in a fate of forward question, because in the past they have not rounded off, and even in the study material they have not given you a clear instruction that you should round off. But if you see the solutions everywhere, they have rounded it off. And as a result, what I would recommend is, if a fate of forward question comes with no specific instruction, then at the end, to be safe, if they tell you to round off to the nearest 0.0025, best. But if they don't tell you, then you write a note. So over here, though this treatment is not applied in other places in this chapter, like even in RTPs or past exam questions, this was not done. In case of a fate of forward question comes and there's no rounding off guidance, it is advisable to write a note that alternatively we can round off to the nearest 0.0025. Now, we don't know what will come in your suggested answer till now, except for, this problem has not really come in the study material, in the suggested answers, RTPs, MTPs. But because if you see the study material, if I can just open this up, and if I go to 10.33, so there are quite a few questions in this fate of forward section, and I mean, there's nothing different from what is there in your material. However, if you look at, let's say, certain questions, if I can find out, let's say, see over here, the question does not tell you anything. It's a normal question. It does not really tell you that you have to, if you see this question, it does not really tell you that you have to round off or anything. But over here, you have rounded, they have rounded this off. In wherever it was not equaling to that 0.0025, they have rounded this off at multiple places. Even over here, I think in the next illustration, they have rounded this off. So the question arises that should I round off? Even over here, they have rounded this off. Nothing is mentioned. So that is why this problem arises, and you can always practice this I think 4, 5, 6 illustrations which are there. You can practice this, but the problem is in the rounding of guidance. So from an exam perspective, if the question remains silent, we will not round off because we don't know what they will do. However, we will mention in a fate of forward question, if it comes, that alternatively you can round off to the nearest 0.0025. You can mention that as a note in your exam. That is your rounding of guidance, only specific to fate of forwards. Remember, these FEDI, Foreign Exchange Dealers Association of India rules, apply largely for fate of forwards. Otherwise, there is no compulsion that every rate between an importer exporter has to be rounded off to the nearest 0.0025. No, there is no such compulsion or guidance. But for fate of forwards, you can practice such questions and at the same time see that your rounding of guidance is kind of applied from an exam perspective. Okay, next you go on into the next chapter, which is international financial management. We'll probably do a question over here, which we have done in the foreign exchange of netting and matching. So when you look at, let's say, one of the ways to manage in terms of international financial management is bilateral hedging, bilateral netting. What do you mean by bilateral netting? Let's say there is a company A, there is a company B. Company A has to pay, let's say, $50 to company B, and company B has to pay, for example, $90 to company A. Now, rather than company A actually going and arranging $50 and paying to company B, and company B going and arranging and paying $90, ideally we can do a bilateral netting and pay just a net or receive just a net $40 over here. So this is bilateral netting, and there's no rocket science over here. You have done various questions where they have tried, there was an export receivable and an import payable, and bilaterally you have netted that off and taken only the net position. But when you look at multilateral, we had done a question regarding, let us say, a parent and multiple subsidiaries, etc. Over here, there is a numerical which can be used on similar lines. So when we are looking at multilateral netting, what we will do is across, let us say, these companies, we'll convert everything into a single currency. Usually that is a parent's currency. We'll convert everything into a single currency, usually the parent's currency, find out the net payable, net receivable by each company, and figure out how much are the net payments which are going to be made or received. So if I look at a question, this is a basic common sense thing, but if it comes as multilateral netting, you have done one question for that. So XYZ from US has subsidiaries in Japan, Canada, Australia, and Singapore. So this is a US company, has subsidiaries at multiple places. The following intercompany subsidiary receivables and payables in US dollar thousands are outstanding at the settlement date. So there's a receiving affiliate, and so this is probably the receiving affiliate and the columns representing the paying affiliate. So over here, maybe The rows are the amount that they are expecting to receive, whereas the columns are the amounts that are expected to be paid. So when I look at, let us say, the Japanese company subsidiary, let's say everything is in dollars. So the first problem is solved. You have to convert everything into the parent's currency. You have done that. So over here, they're going to receive 50, 40, 70. So basically they're going to receive 160. However, what is the payment? So if I total up, this is what I believe 150 they have to pay. Similarly, for the Canadian company, this is what I think 70 and 130 they have to pay. This is 190 they have to pay, and 190 also that they have to pay Singapore company. So if I look at, let us say, the position for the Japanese company, there's a receipt of 160 and they have to make a payment of 150. So there's a net 10 receipt. Canadian company 170 receipt, they have to make a payment of 130. So there's a 40 net receipt. Australian company has a receipt of 150, but it has to pay 190. So there's a net 40 payment. Singapore company has to uh, pay 190, receiving 180. So there's a net 10 payment. So basically, instead of these total receipts and payments, see this total transactions, if I go to see at a gross basis, would have been what? If I total either of these, maybe the rows or the columns, I will get what? I will get around 660. There'll be a total 660 payment that would have had to be done. Now, instead of that, what is going to happen is a net 50 rupees received against a net 50 rupees payment, and that's about it. So when I look at the netting, your total payments would be 660, and if I look at the netting schedule, the net receipt of 50 and the net payment, so what these guys will pay 50 and the recipients will receive 50, and that's about it. So something which was worth 660 of transactions is reduced to 50 worth of transactions, and hence I would say that the reduction in the number of transaction is 660 minus 50. There is 610 worth of transactions not needed. So this will help us in reducing probably transaction costs, etc. Because every transaction you do with the bank, maybe due to the bid and ask spread, etc., there can be a possible cost. So maybe there's a reduction of around 92.42% in the quantum of transactions. So prepare a netting schedule showing the net receipt or payment. So this is a netting schedule showing the net receipt or the net payment, easy. And determine the total amount of payments without netting, which is I think 660, and after multilateral netting, this is 50. Compute the reduction in the fund transfers achieved through netting. I would say that is around 92.42% reduction which is achieved. Okay, so this is largely pertaining to the international financial management. Though in international financial management, I also want to discuss maybe a bit of theory pertaining to the adjusted present value concept. So when I look at the adjusted present value concept, what does the adjusted present value concept say? The adjusted present value concept says that over here, just a second, you will, instead of finding the NPV, what does NPV do? PVCI minus PVCO, and if it is positive, accept, negative, reject. Now, NPV paints every cash flow with the same brush. However, the risk of operating cash flows may be different. The risk of financing cash flows can be different. And as a result, you might be asked to calculate adjusted present value. One of the ways in which adjusted present value can be done is you separate out all the operating cash flows, separate out all the financing cash flows, and do the working. Okay, the operating cash flows will be discounted. Operating cash flows will be discounted. Maybe operating cash flows will be for the firm without considering any interest, any tax savings, nothing like that. This will be discounted at, let us say, the unlevered cost of capital. So had there been no debt, what would have been the cash flow? So you will try to find the present value of the operating cash flows. So this is your operating cash flows discounted at, so this will be operating cash flows discounted at the unlevered cost of capital. This will give you the attractiveness of the project even if you don't take any debt. One way over here is to say that what is the advantage of debt? Well, among other things, the debt gives you tax savings. So there can be a present value of tax savings on interest. Okay, but when I look at this, I will take the interest into tax rate. This will be your tax shield, but this will be discounted at, will I also discount? No, this is a financing cash flow, and the financing cash flow, interest, principal, whatever it is, will be discounted at, as per the institute, pre-tax cost of normalized debt, pre-tax cost of debt. Now ideally one can always argue and say that we should discount it by the post-tax cost of debt, but in the multiple sums which have come, which are there in the material, everywhere they have taken the pre-tax cost. Even in the shield we have written that we should take the pre-tax cost of normalized debt, so you will take that. Now a question has not come, but the study material mentions that there can be interest subsidies. So there can be some benefit that you might get if you were to take debt. So if there are some subsidies, present value of subsidies linked to financing. So present value of interest, subsidy or discounts, if any, over here, if there is, you will again take these subsidies and discount this at the pre-tax cost of debt. And this over here together will give you the adjusted NPV. Now ideally one can always take these workings and do this by taking the operating cash flows separately and then the financing cash flow separately, provided these cash flows are happening in the same currency. So in the question that was there in the study material, which we have also done, there was this toll road project that we were doing, and in that the loan cash flows were also in dollars, the project was also in dollars, and everything was in the same currency. You can do it directly. But if let us say the project cash flows are in a different currency, like it what came in one of the May 26 exam questions, the loan cash flows may be in rupees and let's say the project cash flows may be in euros, in which case it becomes difficult. In such a situation, this is a foolproof method where what you will do is you will take the operating cash flows in, let us say, whatever currency it is, unlevered cost of capital you will take and find the project assessment. Then you take the cash flows for interest, the tax savings on that separately, and the subsidy on interest, if any. In the May 26 question, there was no interest subsidy, but there could have been a concessional interest, in which case you will take the present value of the interest subsidy as well separately, and that will give you, let us say, the adjusted NPV. So this will be adjusted NPV. An example of the adjusted NPV working would be, I think, question number 3A from the May 26 exam, apart from the question which is there in the study material, which is for the toll road question. So this is a May 26 exam question, which you can refer in the video of May 26 that we have shared. That will be a good example base for this adjusted NPV. The theory for this, if you kind of just glance through over here, see what is happening. The APV model is represented as follows. So this is investment, PVCO, plus PVCI, which is X. What is X over here? These are operating cash flows, but discounted at K. What is K over here? This is the unlevered cost of capital. Plus T. What is T? This is tax savings due to financial mix adopted. So this is maybe interest into tax, the tax shield due to financing mix, and you discount it by ID. What is ID? This is a before tax cost of debt. Okay, sir. So we take the pre-tax cost of normalized debt, and the part which was not there in the May 26 exam question is there could be certain interest subsidies, before tax value of interest subsidies due to project specific financing. So if the government is giving you certain subsidy because you have taken, let us say, a loan, then this will arise. Otherwise it will not arise. If it is, the question has to specifically tell you, and because this is arising due to your financing mix, you will discount this again by the before tax cost of debt. And so this is present value of interest tax shields, this is present value of interest subsidies, and together what you get is the adjusted present value. Again, the decision matrix remains the same, that if it is let us say if your APV is positive, you accept; if the APV is negative, you reject. And the last chapter which we would want to discuss here before we stop, and after which we will go on into the derivatives, interest rates, and the remaining miscellaneous topics, the theory topics like securitization, startup finance, we've even financial policy. We have tried to formulate a few numericals for that, is on capital budgeting. On advanced capital budgeting, almost for every area there are sums, whether it is probability approach, certainty equivalent, risk adjusted discount rate, etc., except for simulation. Now in simulation there is a detailed example in the study material which we have also discussed, but maybe some students might not have reviewed what is simulation. Well, Monte Carlo simulation just says that over here, rather than calculating NPV based on one set of expected cash flows, what you try to do is you try to assign random numbers. to, let us say, your important variables like a cash flow, like a project life, for example, and then try to calculate NPV using multiple random permutations, combinations generated. Now, this practically is done by a computer, and maybe there are hundreds, thousands, and lakhs of different combinations. You can just put an input of in a Monte Carlo simulation software, and they can generate different runs for finding these NPVs, and that can be possibly looked at. So you only need to know that if a simulation question is asked, you will have to assign a random number to your important variable, and then based on the random number, it's like a lucky draw, whatever is drawn out, that you will find is associated to what, let's say, cash flow or life, and then you will find. Sir, we'll do that in a numerical set. Like ABC is evaluating a new project. The initial information is 1 lakh, investment project life is 4 years, that is fixed, cost of capital is 10%, and the annuity factor is 3.17. The only uncertain variable over here is how much annual cash flow which you can generate, for which the following probability distribution is given, like 20,000, 25,000, 30 or 35. We don't know what will be generated, but we have assigned probabilities. Now, when you assign probabilities, it starts like 20, 30, 30, and so what we have done is we try to find the cumulative probabilities, and then you assign random numbers, like you assign literally tokens. If you had, let's say, a lucky draw pond, you assign tokens, and you say that for this is a 20% probability, so token number 0 to token number 19, I will have 20,000 return. Then token number 20 to maybe token number 49, I will have 25,000 return. Token number 50 to around 79, I'll have 30,000 return, and 80 to 99, I'll have 35,000 return. Now, for the random numbers which are generated in a computer software, it will generate those numbers, or let us say you can just pick it up from, let us say, the lucky draw pool 12, which means there is a 12 comes within this first bucket, so there will be 25,000 of cash flows. 43 comes in the second, 25 it will be 20 first one, 25 in the second, 68 comes in the third, so this is 68. 85 comes in the fourth, which is 35, and so on. So basically, if I want to find NPV at a 12, 43, 68, 85 and 56 random number, I will say the cash flow will be 20k, 25k, 30k and 35k. Last, it will come to around 56. 56 also comes in the 30,000, so 30k into the PVF. I want to find the NPV, so into PVF this is 3.17, which means I will get, let us say, 20,000 into 3.17 comes to approximately 63,400 minus your investment, which is 1 lakh. So your NPV comes to a negative, I think, 36,600 in the first lot. Second is, I think, 25,000 into 3.17 minus again 1 lakh. Your NPV comes to a negative 20,750. The third one is 30,000 into 3.17. Still it is 95,100 minus 1 lakh, 4,900 negative, and in 35,000 only will it come to be positive. That is around 10,950, and last one again is negative. Now, you can do an analysis and you can find the average NPV considering all of these 5 possibilities, or the question might even ask you that what is the probability of a negative NPV. So you'll say out of 5, 4 runs have returned a negative NPV, so there's an 80% chance of the NPV turning negative. Or if I look at an average NPV, this comes to around 11,240 negative. So I don't really see a lot of other things in your advanced capital budgeting which can separately come. Maybe something regarding Monte Carlo simulation can come, and that kind of wraps up, let's say, this section. We will be remaining with mainly derivatives and interest rates, which has a few interesting concepts, and maybe a few theory topics like securitization, startup finance, and financial policy, which we will cover in the third and the last session. So I hope we are kind of clear with whatever has happened. And in terms of importance, in the index we have marked category A, B and C questions. So I hope this video has been helpful. We'll soon be sharing the third session as well. If you like this video, please press the like button, and it means a lot, has a good token of encouragement for us as well. And also share with your friends if this was helpful. I'll see you soon with the next session and more revision videos and updates. Till then, keep studying, keep smiling, go out and give your best. Your CA prefix is very nearby and you are going to get it very soon. Goodbye, good luck and take care.